Ever feel like you need to decode, a secret language just to understand how some systems work?
Definitely.
Well, today we're sort of handing you the decoder in for a pretty big one. Managing your own provident fund in India. We're talking about exempted establishments.
Right, and we're not just scratching the surface, we're really diving deep.
Exactly. Think of this as your shortcut to wrapping your head around the whole thing. We've gone through the official EPFO manuals and SOPs.
Yeah, the exemption division manual, the main exemption manual, the standard operating procedures for getting the exemption, managing it, even canceling or surrendering it, plus the exempted return manual. Quite a bit of material.
For sure. But the idea here isn't a dry legal rundown. We want to explore how this whole system actually functions, pulling out the key bits.
And hopefully have a few of those moments along the way.
Precisely. So, first things first. What exactly is a PF exemption? What does it mean for an establishment to be exempted?
Okay, so basically under Section 17 of the main PF Act, that's the EPF and MP Act, 1952, certain companies can get permission to run their own provident fund.
Instead of being part of the main EPFO scheme.
Exactly. But there's a big commission. Their own internal PF rules have to be no less favorable to the employees than the standard EPF scheme. That's the core idea. These are the exempted establishments.
And is it just one type of exemption, or are there variations?
Good question. There are mainly two types. You've got the exemption for the whole company, the entire establishment that's under Section 17.1.
Okay.
Then there's Section 17.2, which allows exemption for just a specific class of employees. And that's governed by Para 27A of the EPS scheme.
Right.
And there's even a niche one, Para 27, where the regional commissioner, the RPSC, can exempt just a single employee. It's less common, but it exists.
Interesting. So what's the absolute baseline, the minimum hurdle a company has to clear to even think about applying?
Well, the number one thing is contributions. Their PF contribution rates can't be lower than what's set out in Section 6 of the Act.
That makes sense.
But it's not just contributions. All the other PF benefits they offer, things like how employees can withdraw money, maybe pension aspects if they have them, all of that, taken together, must also be no less favorable than what the EPFO provides. That no less favorable benchmark is really, really critical throughout this whole process.
Okay, got it. So a company thinks, yep, we meet these standards. What's the actual process like? How do they apply for this exemption?
It's definitely a journey, quite a structured one. First, the company, the establishment itself, has to kick things off. They need to apply using a specific standard format.
Signatures, details, all that?
Yep, all the authorized signatures, company details, undertakings, promises, basically, and a bunch of certified documents.
And I remember seeing something about comparing benefits.
Yes, absolutely key. They have to prepare a detailed comparative benefit statement. It literally compares their scheme side by side with the EPS scheme, Form GE15, I believe.
Okay.
And they need to be ready to answer questions from the regional PF commissioner, the RPFC, because they'll likely have some.
So the application goes to the regional office first, the RO.
Correct. It lands there. It used to be all physical paperwork, but now it's moving online, which should streamline things eventually.
And what does the RO do with it?
Their first job is scrutiny. They check if the application is complete, if all the documents are there, and crucially, they have to certify that comparison of benefits.
Ah, so they verify the no less favorable claim.
Exactly. They have to be satisfied that the company's benefits genuinely meet that standard. Once they're happy, they prepare a draft proposal and send it up the chain to the zonal office, the ZO.
Okay, so level 2 is the zonal office. What's their part in this?
The ZO reviews the proposal from the RO. They look at it, make sure it's sound, and then they forward it to the head office, the HO.
With their own recommendation?
Yes, with their recommendation, using a specific form, Form GE3. And they're supposed to do this pretty quickly within 15 days of getting it from the RO.
15 days, okay.
And interestingly, the Zonal Assistant Commissioner also issues something called a relaxation order under Para 79 of the scheme around this time. It's sort of a preliminary step. The ZO also formally certifies that the proposal is ready for the next stage, which involves the Exempted Establishment Committee, or EEC.
EEC. Got it. So the proposal finally makes it to the head office, HO. What's the drill there?
At HO, it lands with the Assistant Commissioner in the Exemption Division. They evaluate it. If the top boss, the Central Provident Fund Commissioner, CPFC, gives the green light, it goes before that Exempted Establishment Committee.
The EEC makes a decision.
They make recommendations. Those recommendations then go to the highest body, the Central Board of Trustees, the CBT.
Okay.
The CBT then consults with the appropriate government, could be central or state, depending on the company, before the final decision on granting the exemption is made.
Wow, that's quite a few layers of review. You mentioned some forms earlier. Can we quickly recap the really essential documents for that initial application?
Sure. The main application form is Form GE1. That crucial comparative benefit chart is Form GE15.
Right.
The formal undertaking or promise is Form GE16. And very importantly, they need consent from the majority of employees. That's Form GE17.
Employee consent. Okay.
Plus things like the trustee, the legal doc, setting up their PF trust, a list of trustees, the company's financial statements for recent years. It's a comprehensive package.
It sounds like it. Are there targets for how quickly EPFO processes these things besides that 15-day ZO to HO timeframe?
Yes, besides that specific one, there's a monitoring system. The regional offices have to send quarterly reports, Form GE5, to their zonal offices detailing the status of pending applications.
Okay.
And the zonal offices compile these and send consolidated reports up to the head office quarterly as well. So there's tracking involved.
Right, makes sense. Okay, fast forward, the company has jumped through all those hoops, they've got their exemption. Is it smooth sailing from there? What are the ongoing responsibilities?
Oh, definitely not smooth sailing in the sense of do nothing. Getting the exemption is just the start. Now the real work of managing it begins.
So what does that involve for the company and its board of trustees?
It's a continuous effort. They have to strictly follow all the conditions listed in Appendix A to Para 27AA of the scheme. That covers a lot.
Like what, for instance?
Well, ensuring the Board of Trustees, BOT, is properly constituted and functions correctly is a big one. They have to cooperate with EPFO inspections and pay the inspection charges.
Okay.
Submitting timely online returns is critical. There's a monthly one, Form RM1, and an annual section, Part F. They absolutely have to ensure seamless service delivery to their employees regarding PF matters.
So making sure employees get their money on time, things like that.
Exactly. Claims, transfers, information it needs to work smoothly. They also have to follow specific disclosure norms, be transparent, and crucially, investing the trust money.
Right, they can't just do anything with it.
No way. They must follow the investment patterns laid down by the central government. Very strict rules there. They also need DMAT accounts for holding securities electronically.
Demand accounts, okay.
And they need to be ready to transfer all the funds promptly if the exemption ever gets canceled. Plus, annual audits by a qualified CA are mandatory, and the BOT has to meet at least quarterly.
That's quite a list. So the EPFO doesn't just grant the exemption and walk away. How do they keep tabs on these establishments?
The regional offices are the main watchers. They regularly scrutinize those online returns the companies file. Form RM1, the monthly one.
Checking for red flags.
Pretty much. They evaluate the performance based on the data submitted, and they conduct a formal compliance audit every single year. That uses Form RM2.
An annual audit.
Yes. And if they find violations during the audit or through return scrutiny, they have a system, a priority matrix they call it, to decide how serious it is and what follow-up action is needed.
And they report upwards.
Yep. The RO sends a yearly summary of their audit findings and compliance status to the zonal office using Form RM3.
So what's the ZO's role in this ongoing monitoring and head office?
The ZO supervises the ROs. They make sure those annual audits are actually happening, that they're timely and thorough. They review the compliance reports from the ROs and forward a consolidated picture to the head office using Form RM4. The head office maintains the overall oversight. They set the policies, issue the SOPs and circulars like the ones we've been looking at, and they also handle capacity building, training for their staff on how to manage all this.
Right. Now, let's shift gears slightly. What happens if things go wrong? When can an establishment actually lose its exemption?
That's covered too, quite clearly. The grounds for cancellation are in Section 17(4) of the Act, and also detailed in that Appendix A to Para 27AA.
What are the typical reasons?
The most common is simply failing to comply with the exemption conditions, like not contributing the right amounts, messing up the investments, not filing returns on time, not transferring funds when someone leaves. Basic compliance failures.
Okay.
Also, if those annual compliance audits find serious adverse issues, that's a major trigger. Financial health matters too. If the trust shows losses for 3 straight years or its capital base erodes significantly, that can lead to cancellation. Condition 25, I think.
Financial stability is key then.
Absolutely. And Condition 29 mentions changes in the company's legal status, like a merger or acquisition, that could also impact the exemption.
So how does the cancellation process actually start? Who kicks it off?
It usually starts at the regional office level. They're the ones monitoring the returns and doing the audits, so they're likely to spot the violation first.
And then what? Do they just cancel it?
No, there's a process. They first issue a show cause notice to the establishment. That's Form CE1.
Yeah.
It basically says, we found these problems. Explain why we shouldn't recommend canceling your exemption.
Giving them a chance to respond.
Exactly. After the establishment responds, or if they don't respond satisfactorily, the RO prepares a formal proposal for cancellation. This is documented in Form CE2.
What goes into that proposal?
It includes all the evidence, the original exemption notification, proof of the violations, like audit reports, return data, and an assessment of the trust's financial situation. They have to send this draft agenda to the zonal office within 30 days of getting the company's reply to the show cause notice.
Okay, 30 days. Then it goes to the ZO.
Yes, the ZO scrutinizes the RO's proposal. If they agree, the zonal ACC recommends cancellation and forwards the whole package using Form CE4 to the head office. Again, there's a 30-day timeline for the ZO to act once they receive it from the RO. The ZO also liaises with the appropriate government during this.
And the final step at head office for cancellation.
Similar to the grant process, really, HO puts the cancellation proposal before the Exempted Establishment Committee, EC, and then the Central Board of Trustees, CBT. The CBT's final recommendations are sent to the appropriate government, which then issues the official cancellation notification. There's a standard format, Form CE3, and the manuals even provide an example notification.
So once it's officially canceled, what happens to all the employees' PF money that the trust was holding?
That's a critical step. The responsibility shifts back to the EPFO. The regional PF commissioner oversees the transfer of all the past accumulations. The PA, meaning all the contributions and interest held by the trust, over to the main EPFO fund.
How is that managed?
It follows Para 28 of the EPF scheme. The cancellation is formally announced via a Gazette notification as well under Para 28.5. And importantly, there's a mandatory third-party audit of the trust fund right at the time of this transfer.
A final check on the books.
Precisely. And of course, the company loses its access to file those special exempted returns online. Their status changes in the system.
Is cancellation the only way an exemption ends? Can a company just decide they don't want it anymore?
Yes, they can. That's called surrender of exemption. A company might choose to do this for various reasons.
Is the process similar?
It is, in many ways. The company applies using specific forms, Form S1 for the application and Form SE2 for details. The EPFO still scrutinizes everything carefully. The transfer of past accumulations, PA, to the EPFO is still mandatory, and there's still a formal notification.
Any specific timelines for that transfer during surrender?
Yes, the SOP mentions timelines. Liquid cash needs to be transferred within 10 days, and any securities need to be transferred within 30 days. So it's quite prompt.
Okay, that covers grant, management, and cessation. Let's just briefly touch on those monthly returns. Form RM1, what kind of data are they submitting regularly?
Right, the online returns divided into parts. Parts A and B are the basics about the establishment name, address, ownership type, main business activity, the exemption details, branches, contribution rates.
Static information, mostly.
Sort of. Once saved, key details like the name, address, Pantan, and whether it's a single or group trust can only be changed by the PF office itself. So it's controlled.
Got it. And the monthly updates?
That's Part C, D, and E. You can only fill these after A and B are done. Part C is employee details. Part D is the big one for finances, all the money coming in and going out.
Receipts and payment.
Exactly. Receipts include contributions, any refunds received, transfers in, interest earned. Payments cover claims paid out, loans given, other payments, and crucially, details about investments made. It tracks the cash balance too.
And Part E.
Part E is mainly for the parent trust if it's a group setup. It focuses on claim settlement performance and grievance redressal stats.
Can you give a couple of key fields from Part D, the finance part?
Sure. On the receipt side, key things are opening balances, securities, and cash, the actual PF contributions received that month, any transfers in, interest received, and proceeds from matured investment. On the payment side, total claims paid, loans issued, total payments made, the amount available for investment, the amount actually invested during the month, and the closing cash balance. They also have to explain any uninvested amounts.
And Part E, those claim settlement and grievance links, what are they tracking there?
For claims, it's things like opening balance of pending claims, new claims received, total claims handled, how many were settled within the target 20 days, how many took longer, the percentage settled on time, and the number still pending with reasons for delay.
Quite detailed tracking.
Very. And for grievances, it's similar. Opening balance, received, total resolved, percentage resolved, and closing balance of pending grievances. It's all about monitoring performance and accountability.
Okay, so bringing this all together, after diving through these manuals and SOPs, what's the main takeaway about how PF exemptions are managed in India?
I think the biggest thing is just how structured and regulated the whole system is. It's not a loose arrangement at all.
Yeah.
There are very defined roles, clear responsibilities, specific procedures for the companies, the trustees, and all the different levels within EPFO, RO, ZO, HO.
Right.
And those timelines we mentioned, they show an attempt to keep the process moving, whether it's granting an exemption or, if necessary, canceling one.
Yeah. And it really strikes me that underpinning all of this complexity is the principle of protecting the employee's benefits. That seems paramount.
Absolutely. From that initial no less favorable check to the ongoing monitoring, the investment rules, the detailed return filing, and especially the procedures for transferring funds if an exemption ends, it all seems geared towards safeguarding those savings.
It's a fascinating balance, isn't it? Allowing companies the flexibility to manage their own funds, but within this very tight framework of compliance and security.
It really is.
Yeah.
And looking at all these detailed regulations makes you wonder, what are the biggest practical challenges, both for the exempted companies trying to navigate all this and for the EPFO in ensuring consistent oversight and protecting those employee interests across the board?
That's a great point to ponder. It's certainly a complex area, and hopefully this deep dive has helped demystify it a bit. For anyone wanting even more detail, those official EPFO resources are definitely the place to go.
Welcome to the Deep Dive. Today we're digging into something quite specific, but really important: EPF exemptions.
That's right. We're talking about when certain companies, establishments, actually get permission from the government to manage their own employees' provident fund money.
Through their own trusts, yeah. It sounds like giving them more control, but I guess it's not that simple. There must be rules.
Oh, absolutely. There's a whole system, a very detailed one, designed to make sure everything's above board and, most importantly, that the employees' savings are protected.
And we're going to unpack this using a standard operating procedure, an SOP, basically the official guidebook for how this all works.
Exactly. It's the rule book. And the absolute core principle, the bedrock of the whole thing, is that the benefits under these private trusts, they have to be just as good, if not better, than what the main employees' provident fund organization, the EPFO, provides.
Okay, so no cutting corners on employee benefits. That's fundamental. This whole thing falls under Section 17 of the main EPF Act, right, from 1952.
Yes, Section 17. That's what gives the government the power to grant these exemptions, but only if, these strict conditions are met.
Got it. So exemptions are a kind of parallel track, but heavily regulated. Our mission today is to really get into the details of this SOP. It's dated November 29th, 2023, called Management Regulation EPF Exemption. Why does this document exist? What's its main job?
Think of it as the clarity document. Its main purpose is to spell out very clearly what these exempted establishments, the ones running their own PF trusts, need to do to stay compliant.
Compliance processes?
Right. And just as important, it details how the EPFO itself, the main regulatory body, keeps tabs on them, how they oversee these trusts, make sure they're sticking to the law and their obligations. It's all about standards and protecting the employees.
And it's not just one single type of exemption this SOP covers, is it? It sounds broader than that.
You're right. It covers a few different scenarios. It applies to exemptions granted under Section 17, subsection 1 of the Act. Also those under subsection 2, which you kind of have to read alongside specific paragraphs 27A and 27 of the EPF scheme itself.
Okay.
And it also includes establishments that have been given what are called relaxations under paragraph 79 of that same scheme. So yeah, different legal routes, but this SOP covers the management aspect for them.
So different ways to get this status, but the management rules are similar. Now, to make this work, there are key players involved, aren't there? Who should we be thinking about?
Definitely. First, you've got the establishment itself, the company, and critically, the group within it responsible for the fund, their Board of Trustees, or BOT.
BOT, okay.
Then, on the regulatory side, you have the EPFO structure. There's the regional office, the RO, headed by the Regional Provident Fund Commissioner, the RPFC. They're like the local supervisors.
Right, the front line.
Then overseeing several ROs, you have the zonal office, the ZO, led by an assistant commissioner, and finally, the head office, HO, setting the big picture policies and watching over the whole system. Understanding each one's role is key.
Let's start with the establishment and its board of trustees then.
Yeah.
Once they get the exemption, what's expected of them day to day or year to year? It can't just be manage it however you like.
Well, not at all. That core promise we mentioned benefits no less favorable than EPFO that's constant. It never goes away.
Okay, that's number one.
Beyond that, lots of regular duties. They have to formally agree, usually through an undertaking, to follow all the rules and also to handle the transfer of any past PF money correctly. That's section 17.5 and para 28 stuff.
Okay, legal commitments.
And they have to actually set up and run their board of trustees properly, following the rules in para 79C of the scheme. The BOT is basically the governing body for the trust. Think of them like a board of directors, but focus solely on managing the PF money responsibly for the employees.
And they have to be open to EPFO checking up on them and pay for it.
Exactly. They must allow EPFO inspections and pay the associated charges. Sometimes they might even be required to get an independent third-party audit done.
Okay.
Plus, they need to keep the EPFO informed about who holds their investments, their depository participants, and who their auditors are. Regular reports go up the chain to the zonal office and head office.
So lots of reporting. What if they want to change their own trust rules?
They have to tell the ZO and HO about any amendments they make. And crucially, they need to understand what actions or failures could actually cause them to lose their exemption status.
Like knowing the grounds for cancellation.
Precisely. Internally, they need meticulous records for each employee's PF account. The SOP strongly pushes for electronic records here, and a big one. Crediting interest to members' accounts monthly, as per para 60 of the scheme.
Monthly interest credit. And keeping employees informed must be key too.
Absolutely vital. Within 6 months of the financial year ending, every member must get an annual statement showing contributions, interest, the whole picture. And the SOP really encourages making this info accessible digitally, maybe even sending monthly SMS or email updates. Transparency for members is important.
Okay, now the really crucial part, managing the money itself. What are the rules around investing the PF funds? This must be tightly controlled.
It is. It's a cornerstone. The BOT must invest the funds strictly according to the investment pattern set by the central government.
Not their own strategy.
No, it's a prescribed list, a government-approved pattern of where and how the money can be invested. Deviate from that pattern, and there are consequences.
Such as?
The CPFC, the head of EPFO, or their representative, can levy surcharges, basically financial penalties. And if the deviations are repeated or really significant, or if they invest in things completely outside the permitted list, that could lead straight to cancellation of the exemption.
Wow, okay. So stick to the script on investments.
Yeah.
It's a safeguard, right? To stop risky investments with people's retirement savings.
Exactly. It prevents trusts from gambling with employee money. History shows why that oversight is needed.
Makes sense. What about other financial controls? How are the investments actually held?
They have to make sure all the securities, the actual investments, are held directly in the trust's name. And they must be in electronic or DMAT form.
DMAT, like shares nowadays.
Right. And those DMAT accounts can only be with depository participants registered with the RBI or the central government, another layer of regulation.
And if they need to sell investments, say to pay someone retiring?
They need permission first.
Yeah.
From the RPFC, the regional commissioner. They can't just sell assets whenever they want, even for valid payouts, without approval.
Okay, checks and balances.
Also, any commissions or bonuses the trust might get back from financial institutions on its investments, that money has to go straight into the trust bank account. Full transparency.
No side deals.
None. And finally, the annual audit. Every year, their PF accounts have to be audited by an independent chartered accountant. That report, along with the audited balance sheet and P&L, goes to the RPFC within 6 months of the financial year end.
And they might have an investment committee too.
Yes. The SOP mentions the BOT can set up a dedicated investment committee to help manage these crucial financial decisions. It's an option.
That's a very thorough list of duties. And you mentioned deadlines earlier. Can we quickly recap the main ones?
Sure. Monthly contributions, employer and employee shares need to hit the BOT's account by the 15th of the next month.
15 for contributions.
The big online annual return, Part F. That's due by April 25th for the year ending March 31st.
April 25th, got it.
If they need to update basic info about the establishment or trust parts A or B that needs doing online by the 25th of the following month.
Okay.
And as we said, the auditor's report, balance sheet, annual report, all that financial stuff within 6 months of the financial year ending.
Yeah.
Same deadline, 6 months for giving members their annual statements.
Right, keeping those timelines is clearly critical for compliance. Okay, so that covers the establishment and BOT side pretty well. Let's switch to the regulators.
Yeah.
The regional office and the RPFC. What's their role in watching over these exempted trusts?
They are, as you said, the frontline supervisors. Their job involves regularly scrutinizing those online returns, the trusts file, that's Form RM1. They're looking for any red flags, any non-compliance.
And if they find issues?
That can lead to action, penalties, maybe further investigation, and potentially starting the process to cancel the exemption if things are serious. A major task for the RPFC is ensuring the annual compliance audit gets done for every exempted trust in their region.
The annual audit, what's involved there?
It's done by EPFO officers using a standard checklist, Form RM2. The goal is to check if the trust is actually meeting all the conditions of its exemption, always focusing on protecting the workers' interests.
And they use that priority matrix you mentioned.
Yes, the priority matrix guides the audit, helps focus on what's most critical. We can talk more about that matrix, but it ranks violations. The audit team also has specific instructions to look for certain mandatory cancellation triggers.
Automatic red flags.
Exactly. For example, if the establishment has been making losses for 3 years straight, or its capital base has eroded significantly, that's condition 25, or if the company's legal status changes like a merger or takeover, that's condition 29, finding these means the cancellation process must start.
So the RO has to spot those big ones.
They do. The audit also checks how the trust handles any surplus funds and verifies their crediting interest correctly according to the rules, like Para 60.
And investment deviations?
They look for those too. If they find the trust hasn't followed the investment pattern, the first step is usually imposing those financial surcharges we talked about at specified rates.
Okay. Can the RPFC go deeper if they suspect bigger problems?
Yes. If the RPFC feels a standard audit isn't enough, maybe based on the RM1 returns or other info, they can order a third-party audit. This uses Form RM6.
An independent look.
Right, but they need to justify it in writing, document the reasons, and they have to inform their zonal office afterwards. So there's oversight on ordering these deeper dives too.
Makes sense. And the results of all these annual audits?
The RPFC compiles a report summarizing the compliance audit position for all trusts in their region. This goes to the zonal office using Form RM3 by January 15th each year.
Okay, so the RO reports up to the zone. Let's talk about the zonal office then, the ZO and the assistant commissioner there. What's their piece of the puzzle?
The ZO basically oversees a group of regional offices. The assistant commissioner ZO monitors how well those ROs are doing their job regarding these exempted trusts.
Checking the checkers.
In a way, yes. They track if the ROs are ensuring timely filing of online returns, Form RM1, and if they're effectively using that online performance evaluation system the EPFO has.
The one that scores the trusts.
That's the one. Based on that performance data, the ZO might send out advisories or instructions to the ROs to, improve monitoring or focus on specific areas.
So driving consistency and performance across the regions.
Exactly. The ZO also closely monitors whether the annual compliance audits are actually being completed on time across all their ROs, and importantly, what follow-up action is being taken on any problems found during those audits. They need to see rectification.
Right, not just finding problems, but fixing them.
Absolutely. And then they consolidate all this compliance audit information from their ROs, from the RM3 forms, into a single report for the head office. That's Form RM4, due by January 25th.
Keeping head office informed. Anything else the ZO does?
Yes. They're also tasked with organizing things like annual meetings or outreach programs for the exempted establishments in their zone. It's a way to share best practices, discuss common issues, and for EPFO to communicate directly with these trusts.
Fostering a sense of community and sharing knowledge. Good idea. Now, you mentioned third-party auditors, the TPAs, earlier. The zonal office is involved in setting that up.
Yes, the ZO is responsible for creating the panel of approved TPA firms for their zone. And there are pretty strict eligibility criteria for audit firms wanting to get on this panel.
What kind of criteria?
Well, they need to be registered with the Institute of Chartered Accountants of India, obviously. They need at least 10 years in existence, a minimum of 5 partners, with at least one being a senior FCA.
Experienced firms.
Right, and experience auditing large companies' turnover above 50 crore rupees. They also need a decent average annual turnover themselves, 1.5 crore over the last 3 years, and importantly, a clean record. No professional misconduct, no major penalties against them.
So they're vetting these firms quite carefully. How does a firm get selected?
The ZO invites applications, often through the government e-marketplace, GEM. Then a scrutiny committee reviews them. This committee usually has the RPFCI from the ZO, the most senior RPFCI in the zone, and an expert from the ICAI.
A panel review.
Yes. Based on their recommendations, the zonal ACC approves the final panel. They aim for a reasonable number, maybe 5 or more firms per zone. The impanelment is usually for 3 years, possibly extendable year by year, up to 3 more years based on good performance.
And how are they assigned work?
When an RPFC decides a TPA is needed, they pick from the zonal panel. It's supposed to be done proportionally and randomly. And there are limits. A firm shouldn't have more than, say, 3 audits pending at once. And critically, the same firm can't audit the same trust 2 years in a row.
To ensure independence.
Exactly. And there are rules for kicking a firm off the panel early if they mess up or don't perform.
Okay, that covers the ZO's role, including the TPAs. What about the very top, the head office? What's HO's involvement?
The head office provides the ultimate oversight. At least until this new digital dashboard they're planning is fully up and running, HO monitors how well the zonal offices are performing.
Checking the ZOs.
Yes, checking if ZOs are ensuring timely compliance audits by the ROs and that trusts are filing their online returns correctly. HO can also monitor those returns directly through a specific interface they have.
A top-level view.
Right. And they review those consolidated compliance reports, the Form RM4s coming up from all the ZOs. It gives them the national picture. HO also sometimes collaborates with an organization called PDU-NAS to run specific outreach programs with selected exempted trusts, maybe focusing on national policy issues or complex areas.
So it really is a layered system, establishment BOT, RO, ZO, HO. And you mentioned several forms, RM1, RM2, etc., and the online system. Can you quickly tie those monitoring tools together?
Sure. So the RO uses Form RM1 for checking the regular online filings and the online performance evaluator system for scoring compliance. They use Form RM2 for the actual annual audit process. Their summary report up to the ZO is Form RM3. If a deeper dive via a third-party audit is needed, that uses Form RM6 for the TPA's report. The ZO uses the online evaluator data and the RM3s from its ROs, then sends its consolidated picture up to HO using Form RM4. Form RM5 seems to be more for internal analysis based on audit findings, and that online performance system itself gives everyone a snapshot based on those key metrics.
And that priority matrix seems central to deciding what happens when rules are broken. Could you explain the ABC categories again?
Yeah, it's quite logical. It's detailed in a form called CE6, which is actually part of the SOP for canceling exemptions. Category A violations are the big ones, immediate show cause notice for cancellation.
Examples.
Things like 3 years of losses, not depositing PF dues, not getting the mandatory audit done, securities not in DMAT form, failing to file online returns for 3 months straight, that kind of serious stuff.
Okay, category A is bad news. What about B and C?
Category B violations are still serious, but the trust gets a chance, a specific time frame, to fix it. If they don't fix it in time, or if the same B violation happens again the next year, then it can escalate to cancellation proceedings.
So a warning, but with teeth.
Right. Category C are less severe initially. The trust gets advised to be more careful to rectify it. But if a C violation keeps happening, say for 3 consecutive times without being fixed, that too can trigger the cancellation process. It's about seriousness and persistence.
That provides a clear escalation path.
Yeah.
Makes sense. And the online performance evaluator, the scoring system, what were those 6 parameters again?
Right. It scores trust out of 100 on 6 things. 1, transferring PF funds on time. 2, investing at least 70% correctly according to the pattern. 3, remitting the full PF amount each month. 4, declaring interest equal to or higher than EPFO's rate. 5, settling claims quickly within 10 days. And 6, getting the annual accounts audited. Points get deducted for falling short on any of these.
A quantitative snapshot of compliance. Okay. Let's circle back to those third-party audits one last time. We know the RPFC initiates them with justification. What exactly are these TPAs usually asked to look at or certify?
The main point is that extra independent check. When ordered, the TPA firm typically has to verify a couple of key things beyond just the financials. They need to certify that the legal status of the company hasn't changed since exemption was granted.
Like no mergers or anything hidden.
Correct. And they specifically need to check and report on whether the company has suffered erosion of its capital base or if it's reported losses for 3 consecutive years. These are those critical financial health indicators, Condition 25 territory again.
Checking for those major red flags.
Yes. They compile their findings and submit the report using that Form RM6, usually within 30 days of getting the work order.
And how are these firms paid? Is it standardized?
It's structured. The fees are based on the minimum recommendations set by the ICAI, the Accountants Institute. But they also factor in the location city classification like Class A, B, C cities, because costs differ.
Like metro versus smaller town.
Exactly. The SOP even gives indicative fee ranges for different tasks, like a standard tax audit or a full company audit, which itself is broken down by company size, small PVT Ltd, medium large public Ltd. They also mention fees for things like checking TDS compliance. The final fee can also depend on how complex the trust is and how much time the audit actually takes.
Okay, so it's guided but allows for complexity. It's definitely clear now that this isn't a simple area. Managing and regulating these EPF exemptions is pretty involved.
It really is. It's a constant balancing act, isn't it? You're giving these establishments the autonomy, the freedom to manage funds, but at the same time, you need incredibly robust oversight to protect the employees' money. That's their retirement security on the line.
And this SOP we've been discussing seems like the blueprint for that balance.
Sure.
Clear roles, clear procedures, this multi-level monitoring from the BOT right up to head office.
That's the idea behind it, to make the system work effectively and ensure those foundational principles are upheld.
And the consequences for getting it wrong are significant. We talked about surcharges and ultimately losing the exemption status altogether, which means the EPFO takes back control.
Precisely. So while this deep dive gives, I hope, a really good overview and covers the critical points, essentially acting as a guide to what's in that SOP, anyone directly involved, whether managing a trust or overseeing one, really should read the full document. The devil's always in the details.
Absolutely. It brings up a final thought, doesn't it? This balance between autonomy and regulation is something so critical. How do we really ensure consistently across all these different exempted trusts that the benefits are always truly no less favorable? Are these checks and balances, these audits and reports and online scores, are they ultimately enough to guarantee that protection for every single employee in the system? It's something worth pondering. Thanks for walking through this complex process with me.
My pleasure. It's an important area to understand.
Ever find yourself wondering how those really large companies handle their employees' provident funds outside the usual government system? It touches on some pretty intricate stuff.
Exactly. And it's fascinating because this isn't some, informal thing. There's a whole framework, a really detailed set of rules laid out by the EPFO.
Which brings us right to our topic today. The Employees Provident Fund Organization, EPFO, their Exemption Division Manual. Now that might sound a bit, dry?
Maybe a little. But look, this document is actually the key. It unlocks how certain places in India get permission to manage their own employees' provident funds instead of the standard route.
Yeah, and this manual gives you the complete picture, how exemptions are granted, how they're regulated day to day, and even how they can be canceled or, given up voluntarily.
Absolutely. It covers the whole life cycle, really.
And why should you, our listener, care about this? Well, if you're in HR, finance, or honestly just curious about how Social Security works in India, this is gold.
It really is. It's like an insider's guide to employer responsibilities and the safeguards protecting employees' futures.
We've gone through the whole thing. Exemption Division Manual 041202023.pdf to pull out the really important stuff for you. Save you wading through all the jargon. Our goal is to make this clear, comprehensive, and hopefully kind of interesting.
And fundamentally, like the manual says, it's all driving towards ensuring a secure future for EPF beneficiaries. Understanding this helps see how that works in practice.
Okay, so the plan for this deep dive. We'll start with the basics. What is exemption here? Then how do companies actually get it?
Right. Then we'll look at how they're managed once they have the exemption.
And inevitably, what happens when things go wrong, cancellation? Or when they choose to opt out, surrender.
And finally, the governance structure holding it all together.
Sounds like a plan. Let's dive in.
Okay, first things first. What is an exempted establishment? Section 2 of the Main Act, the EPF and MP Act 1952, defines it. Basically, it's an establishment granted exemption under Section 17.
And that exemption can cover everything, or just parts of the scheme, like the insurance scheme.
Exactly. It can be all provisions or just some.
Wow.
And it could apply to the whole company or maybe just certain groups of employees or even individuals.
Interesting. So it's flexible. Now, this wasn't always the setup, was it? There's a history here.
Oh yeah. It goes back to an ordinance in 51, then the Act in 52. The EPF scheme itself started November 1st, 52. That's EPFO Foundation Day.
Right?
And Section 17 was there from early on, letting the government grant exemptions. A key change came in 88, though. They added a requirement to consult the central board before granting one.
So an extra layer of oversight came in.
Right, and the manual notes that the core procedures haven't drastically changed since October 88.
So a fairly stable system for the last few decades. You mentioned different sections allowing exemption. Can we break those down? What are the legal routes?
Sure. Section 17(1)(a) and B are probably the main ones.
All right.
They allow exemption if the company's own benefits, PF, pension, gratuity, are, and this is key, no less favorable than the EPFO's.
That phrase seems important. No less favorable.
Crucial. Then you have Section 17(1)(a). This clarifies that even exempted places still have to follow core parts of the Act, things like contributions, recovering dues, penalties. It also covers setting up their own boards of trustees.
So they don't get a free pass on everything.
Not at all. Section 17(2) allows exemption for specific classes of employees linked to Para 27A of the scheme. And Para 27 of the scheme allows it for individual employees in certain cases.
Okay, different pathways. But surely it's not just about having comparable benefits. There must be strict conditions, right, and keep the exemption.
Absolutely. Appendix A to Para 27AA spells these out. The manual helpfully groups them by who's responsible, the Board of Trustees or employer, the employees, and the EPFO itself.
Let's start with the employer or their board of trustees. What's on their checklist?
Quite a bit. They have to formally set up the board, meet every 3 months minimum, and enroll all eligible employees. Ensure benefits are truly no less favorable, contributions, interest, advances, the lot.
And they have to keep pace if EPFO improves things.
Yes, any beneficial EPFO rule changes apply automatically. They need electronic accounts, must invest funds according to government guidelines. Specifically, securities held in the trust's name, in DIMIT form, with RBI-approved depository participants.
Wow, that's specific.
Very. They even need directions for those participants to transfer investments to the RPFC. That's the Regional Provident Fund Commissioner if things go south, like cancellation. Plus, submit balance sheets, rotate auditors.
Rotate auditors.
Yeah, can't use the same one for more than 2 consecutive years or more than 2 years in any 6-year block. And importantly, they have to make good any losses from fraud or bad investments. There are even conditions for mandatory revocation.
Okay, heavy load on the establishment. What about protecting the employees in this setup?
Key conditions there too. Employees must get timely claim settlements. They need a passbook facility from the trust and the ability to check their balance easily, like on a computer.
So access and transparency for the employee. And EPFO's role, what conditions empower them?
They hold significant power. The establishment needs EPFO permission for any rule changes. Permission from the RPFC is needed to liquidate investments, even for essential costs.
So checks on financial moves.
Definitely. EPFO can order a third-party audit if they have concerns, maybe if the trust shows losses for 3 years straight. They can also launch a compliance audit anytime, really. And they initiate cancellation, starting with a show cause notice.
And they can go after trustees legally if needed.
Yes, the RPFC can take legal action against all trustees of a common PF trust in case of default. And, overriding all this, the central government can always add more conditions.
It's a real web of checks and balances. So getting the exemption granted, who actually does what? Walk us through the players.
Okay, the establishment kicks it off. They form the trust, write the rules, then apply using a standard form. Crucially, they include a statement comparing their benefits to EPFOs, showing they're not less favorable.
That comparison seems vital.
It is. The application goes to the regional office, the local EPFO branch. They scrutinize it. If they agree the benefits are comparable, they prepare a draft proposal and send it up to the zonal office.
So first hurdle cleared at the RO, what happens at the ZO?
The ZO reviews the draft, adds their recommendation and forwards it to the head office HO. Interestingly, the zonal ACC also issues something called a relaxation order under Para 79 around this time.
Okay, then it lands at head office.
Right. HO does the deepest dive. They evaluate it, get the CPFC's initial okay, then present it to the Exempted Establishments Committee, the EEC. If the EEC approves, HO issues the exemption notification, but only after final approval from the appropriate government.
Phew, that's quite a chain. So, quick summary of the flow.
Establishment applies to RO. RO scrutinizes, forwards to ZO. ZO certifies, forwards to HO. HO evaluates, presents to EEC. EEC presents to the Central Board of Trustees, CBT. CBT recommends to government. Government approves and notifies.
Got it. So once they jump through all those hoops and get the exemption, does EPFO just step back, let them run things?
Oh, absolutely not. The manual is very clear. Regulation is ongoing. It's based on the law, the fact it's for employees' benefit, the employer's duties, and EPFO's role as the regulator. It doesn't stop at the grant.
Makes sense. So who's responsible for what in this ongoing management phase?
The establishment and its board of trustees have the main day-to-day duties. Manage the fund per guidelines, stick to all the exemption conditions, keep the board properly constituted, facilitate EPFO inspections, pay charges, file online returns.
Seems like a lot to keep track of.
It is. Plus, ensuring seamless service for employees, being transparent with annual reports and accounts, and very important, reporting any changes in their legal status, like mergers or sales.
Okay. And the EPFO side, RO, ZO, HO.
The regional office does the legwork on the ground. They conduct those compliance audits we mentioned and report findings up to the zonal office. They also process the online returns the establishments file.
So the RO is the main point of contact and audit.
Primarily, yes. The zonal office supervises the ROs. They monitor if audits are done on time, if returns are filed correctly, and they report upwards to the head office.
And head office.
Head office oversees the ZOs. They also handle the bigger picture stuff, national outreach, capacity building programs for everyone involved.
So it's a constant loop. Establishment complies, RO audits, ZO monitors, HO oversees. What does that look like practically?
It hinges on the establishment sticking to the rules board functioning, smooth employee processes, timely interest credits, efficient claims, rule changes automatically, get permission for their own rule changes.
And file returns, manage investments properly.
Exactly. Timely returns, investments strictly following the pattern, all in DMET form. The ROs check this through the compliance audits, and the ZOs keep an eye on the ROs. It's a continuous regulatory cycle.
Okay, now, the less happy path. What if an establishment doesn't uphold its end? How does an exemption get lost?
Right. The manual stresses exemption is a privilege. It's for companies that are financially sound and provide those comparable benefits. If that changes or they don't follow the rules, the privilege can be taken away. It's not set in stone.
Are there specific red flags, sort of trigger points, that make EPFO sit up and take notice?
The manual doesn't list them quite like that, but you can see the patterns. Consistent failure to meet the conditions, signs of financial trouble in the trust or the company itself, major changes in legal status like a takeover. These are definitely things that would trigger scrutiny and could lead towards cancellation.
Makes sense. So if issues are found, what's the actual legal basis for pulling the plug on an exemption?
The main authority comes from Section 17.4, specifically Parts A and B of the EPF Act. This gives the government power to cancel if the establishment breaks the rules or if the employer defaults on contributions to their own trust fund.
So rule breaking or non-payment?
Those are key. Also, remember Condition 29 from Appendix A? That mandates revocation if the company's legal status changes significantly, sale, merger, etc. And Condition 25 allows withdrawal if they have losses for 3 years running or their capital base erodes badly.
Okay, several clear grounds.
Yeah.
Who are the players in the cancellation process? Similar to granting.
Largely, yes, but the focus shifts. The establishment and its trustees need to fix problems if asked, cooperate with audits, and crucially, tell the RPFC immediately about any legal status changes. If canceled, they have to ensure the funds get transferred smoothly to EPFO. Their depository participants are key here for moving the investments.
And EPFO's role in cancellation.
The regional office usually spots the non-compliance first. They issue the show cause notice asking for an explanation. They conduct audits to build the case, then prepare a draft agenda recommending cancellations, sending it to the ZO.
So the RO builds the case file.
Pretty much. The zonal office reviews this, coordinates with the state government if needed for the final notification, and tells HO to cut off the establishment's online access.
And finally, head office.
Head office gives the draft agenda a final, thorough review. They present it to the EEC, then the CBT for the decision. If they agree on cancellation, HO sends the recommendation to the government, which issues the formal cancellation order.
Seems quite thorough. Can you walk through the typical steps again for cancellation?
Sure. RO spots issues show cause notice, establishment replies, or doesn't. RO prepares draft cancellation agenda for ZO reviews, forwards to HO presents to EEC and CBT, decision made, recommendation to government issues cancellation notification. There are also timelines mentioned for getting that third-party audit done during this process.
Is that third-party audit always required before the final decision?
Usually yes, but the manual mentions exceptional circumstances. Maybe the audit just isn't feasible right then. The RO and ZO-ACC can make a case to proceed to the CBT without it, with strong justification.
But the audit does happen eventually.
Absolutely mandatory. Even if waived earlier, a full third-party audit must be done when the actual funds, the past accumulation dues, are transferred to EPFO after cancellation is finalized. No exceptions then.
Right. Got to ensure the money is right before transfer. Now, you mentioned court cases earlier. It seems this area has seen some legal challenges.
Yeah.
What key ideas have come out of those court rulings?
Yeah, the manual summarizes some key principles. A big one, consistently upheld, is that exemption is a privilege, not an inherent right.
Okay, that sets the tone.
Definitely. Courts have also clarified things like an exemption can't just continue for the trust if the company itself disappears. Makes sense, right?
Yeah, the trust needs the underlying entity.
And any changes to the rules for an exempted trust need proper notification to be valid. Also, crucially, once canceled, the employer and employees can't just decide to drop contribution rates back to the minimum statutory level.
So they can't just revert automatically. Interesting. These rulings really reinforce the responsibility involved.
They really do. It's serious business managing these funds.
Okay, what if a company decides, you know what, this is too complex, we want back into the main EPFO system? Can they voluntarily give up their exemption?
Yes, absolutely. That's called surrender of exemption. It's when an establishment chooses to relinquish its exempted status and hand the PF management back to EPFO.
Why might they do that?
The manual suggests it's becoming more common. Maybe they want to focus on their core business. Maybe the complexity or market risks of managing the fund are just too much. Handing it back to EPFO simplifies things for them.
Okay, so how does that surrender process work? Who does what?
The establishment initiates it. They need to inform EPFO well in advance, usually via a board resolution. It's not immediate. It takes effect from a future date. They need to prep a list of beneficiaries, ideally with KYC details.
And audits are involved here too.
Yes, they need to arrange a third-party audit, coordinating with the RPSC. Their big job is transferring all the past accumulation PA funds to EPFO and sorting out any employee grievances before the surrender is final.
So get their house in order first. What about the EPFO side?
The regional office follows specific steps before and after the surrender notification. They might let the company start complying like an unexempted one once the PA transfer and audit are underway. After notification, they ensure all PA is transferred correctly and check compliance with Para 28.5 of the scheme. The focus is on a smooth transition for employees, getting their funds credited quickly.
And ZO and HO.
The zonal office reviews the RO's draft agenda for surrender and forwards it to HO. The head office exemption division scrutinizes it before it goes to the EEC and then the CBT. If approved, the recommendation goes to the government for the final surrender notification. HO's investment division also confirms the value of securities being transferred.
So similar approval chain as granting or canceling, just initiated differently. What happens right after the surrender order, Form SE5, is issued? Any immediate deadlines for the employer?
Yes, specific timelines kick in. They have 25 days to submit the detailed PA statement. The cash part of the funds needs to be transferred within 10 days, usually by demand draft. And any government securities held have to be transferred within 30 days.
Okay, strict deadlines to wrap things up. Now, we've talked about third-party audits and compliance audits quite a bit. They seem critical. Can we clarify the difference and purpose of each?
Good idea. The third-party audit is really about checking the financial health and overall management of the trust itself. It's an independent assessment.
And who can conduct these? Any specific qualifications?
Yes, there are criteria. The audit firms need to be ICI members, have enough full-time partners who are fellow chartered accountants, FCAs, and have experience auditing larger companies. They apply through the government e-marketplace, GEM,
And how are they selected?
A committee reviews the applications. It usually includes the RPFCI from the RO, the senior RPFCI from the ZO, and an ICI expert. Once chosen, the auditors have 30 days to submit their report after the audit using a specific format set by EPFO.
Okay, so that's the independent financial health check. What about the compliance audit?
The compliance audit is different. It's mandated by the exemption conditions themselves, specifically Condition 26. It applies to all exempted establishments and must happen at least once every 3 years, though EPFO can order it more often if needed.
And the timing.
There's a hard deadline. It must be completed by December 31st of the financial year, which gives them about 3 months after the annual reports are usually finalized.
What happens with the report?
The findings go into Form RM3. The ZO compiles the status for their region in Form RM4 and sends it to HO.
And if the compliance audit finds problems, violations,
Then the RO issues notices demanding correction. Depending on how serious the violations are, this could be the start of the cancellation process following that priority matrix the manual mentions.
it really sounds like a robust system for oversight. The manual dedicates a whole chapter to the governance structure. Why is that structure so important here?
Well, given how many employees and how much money is involved in these exempted funds, a clear structure is vital. It ensures accountability, consistency, and effective regulation across the board. You need clear lines of responsibility.
Makes sense. So what does that structure look like? Who sits where in the hierarchy?
It's multi-layered. At the top, you have the head office. They set policy, interpret rules, monitor the field offices, ZOs and ROs, and handle capacity building. Within HO's exemption division, there are specialized teams.
Okay.
Then there's the Exempted Establishment Committee, or EEC. This advises the Maine Central Board of Trustees, CBT, on policy for the exempted sector. They deal with tricky issues like defaults or impacts of tax law changes. The CBT itself is the ultimate decision-making body.
Below the national level.
You have the zonal offices, each led by an ACC. They oversee the regional offices in their zone, monitoring things like return filing and audits. And then the regional offices, led by RPFCs, are the front line. They're the main contact point for establishments and conduct the compliance audits.
And how does EPFO make sure everyone involved, both their own staff and people at the exempted trusts, actually understands all these complex rules?
They use a three-pronged approach for capacity building. At the RO level, it's about adequate staffing and training via the zonal training institutes, which have specific exemption modules.
Okay, internal training.
Right. At the ZO level, it's more external facing. They run seminars for the establishments themselves, sharing best practices, answering questions.
Getting the establishments up to speed.
Exactly. And at the HO level, it's national. The main training academy, PDUNAS, organizes programs for trust personnel covering investments, management, legal stuff, the whole gamut.
Comprehensive training approach. The manual also mentioned a matrix of timelines. What's that about?
It's basically a handy summary chart. It lays out the main tasks for cancellation, regulation, granting, and surrender, showing who is responsible for what and the deadlines they need to meet. It promotes efficiency and makes the workflow clear.
Useful reference.
Yeah.
And lastly, how does EPFO keep continuous track of everything? What are the monitoring tools?
There are regular reviews built into the system. At HO, the ACC exemptions reviews with zonal ACCs monthly, and the CPFC reviews quarterly. At the ZO, the ACC reviews with their RPFCs fortnightly. And at the RO, the RPFC reviews with their team fortnightly too.
Lots of meetings.
It ensures constant oversight. Plus, the ZOs send a detailed monthly report to HO covering pending proposals, audit status, all the key metrics. This gives HO a real-time dashboard of what's happening nationwide.
Wow. Okay, that was genuinely a deep dive. It's clear this isn't just some side arrangement. It's a highly structured, regulated system. So, quick recap for everyone listening.
Yeah, we covered what exemption means, the detailed steps to get it, the ongoing oversight required, how it can be canceled or surrendered voluntarily, and the whole governance structure keeping it in check.
It really shows that balance, doesn't it? Giving capable companies autonomy, but with very firm guardrails to protect employee interests.
Absolutely. And I think for me, one aha moment was just how incredibly specific the conditions are, things like the auditor rotation rules or the exact requirements for holding investments. It shows the level of detail EPFO demands.
Definitely not taking it lightly. So for you, our listener, we hope this has shed light on a complex but really crucial part of India's social security system. Whether it's for your job, your studies, or just understanding where retirement funds go, knowing these rules offers real insight.
Maybe it's even sparked some curiosity to look deeper into, say, the Social Security Code 2020 or some of those court cases we mentioned.
And to leave you with something to think about, as India's economy and workforce keep changing, how might this balance between public, EPFO, and private exempted trust management of retirement funds shift in the future?
And what role will these very detailed exemption guidelines play as that future unfolds? Something to ponder. Welcome to the Deep Dive. We're here to take complicated stuff and, pull out the key bits for you. Basically, your shortcut to getting up to speed.
That's right.
Today, we're digging into something that might seem a bit niche, but it's actually pretty important for anyone in HR, dealing with benefits or just curious about how companies handle employee money.
We're talking about how a company can manage its own provident fund trusts instead of using this standard EPFO system.
Exactly. We've waded through the official standard operating procedure, the SOP, for getting this exemption, and we're going to walk you through it step by step.
Yeah, think of this as the audio version of that dense document. We'll break down why a company might do this, what the process actually looks like, who's involved, basically everything you need to understand EPF exemption without reading the whole manual yourself.
Okay, let's dive in. First things first, what exactly is exemption in this EPF world?
Right. So basically, exemption means a company gets the green light to manage its employees' provident fund money itself through its own trust, instead of everything going through the main employees' provident fund organization, the EPFO.
Okay, so they set up their own little fund.
Kind of, yeah. The legal basis is in the main EPF Act from 1952.
Nice.
Section 17 is the key part. Section 17(1) lets the whole company get exempted.
A whole place.
Yep. Or there's Section 17(2), along with a specific rule, Para 27A in the EPF scheme, which lets them get exemption just for a certain group of employees, maybe managers or people in a specific division, something like that.
Okay. But hang on, this isn't about companies trying to avoid giving PF benefits, right?
Oh, absolutely not. That's the critical point. The absolute bedrock principle here is that whatever the company's own trust offers, the benefits have to be, and this is the official phrase, on the whole, not less favorable than what employees would get under the normal EPS scheme.
Not less favorable, so equal or better.
Exactly. They can't shortchange their employees just because they're managing the fund themselves. Maybe they offer a slightly better interest rate, perhaps, or slightly different withdrawal rules, but still within the regulations. It has to pass that not less favorable test.
That makes sense. So if the benefits have to be just as good anyway, why would a company go through all the hassle of setting up and running its own trust? It sounds complicated.
It is complicated. The SOP doesn't spell out all the motivations, but the big implied benefit is, well, control. More direct control over how their employees' PF money is managed and invested.
Control how? Like choosing investments?
Potentially, yeah, within strict government guidelines, of course. Maybe they feel they can tailor things a bit better to their specific workforce, or maybe they see some long-term strategic or even perhaps cost advantages. But remember, the EPFO still keeps a very close eye on them.
Okay, got it. So let's say a company decides, yep, we want this control, we want to go for exemption. What's step one? What do they do first?
Right, the very beginning. Phase 1 is all about the company, the establishment itself, doing its homework, what the SOP calls due diligence.
Due diligence sounds serious.
It is. They need to really scrutinize all the conditions laid out for exemption. They're listed in the main application form, GE1, and be absolutely sure they can meet every single one.
And what kind of things are they sorting out at this stage? What needs to be in place?
Well, one of the biggest jobs right at the start is creating their own Provident Fund Trust rules. Their rule book, essentially.
And they can just make up any rules?
Oh, no way. These rules have to follow, very strictly, the conditions listed in Appendix A to Paragraph 27AA of the EPF scheme. That Appendix A is like the detailed blueprint for how an exempted trust must operate. It's non-negotiable.
Okay, Appendix A is the blueprint.
Yeah.
Got it. So they've drafted their rules based on that. What's the very next thing?
The formal application, that's Form GE1. And it's not just a simple form. It needs a lot of information and documents attached.
Like what? Give us some examples.
Okay, so they need 2 signed copies of those PF trust rules we just talked about. And if they're only applying for that specific group of employees under Section 17(2), the rules must clearly define who is in that group and who isn't. Super specific.
Right. No gray areas allowed. What else goes in the package?
Then you've got these mandatory certificates of undertakings. Think of them as legally binding promises signed by the employer and the trustees they appoint.
Promises about what?
Key things, like Condition No. 22 is basically saying, we promise to follow all the rules to keep this exemption. And Condition number 23 says, if our exemption gets canceled for any reason, we promise to transfer all the money back to the EPFO super quick, and we accept penalties if we're late.
Wow. Okay. So serious commitments to protect the employees.
Absolutely. That's a huge focus for the EPFO. Then another really vital piece is the comparative table of benefits.
Ah, the not less favorable proof.
Exactly that. It's a side-by-side chart showing their proposed benefits versus the standard EPF benefits. And the employer has to sign it, certifying, yes, ours are as good or better. It directly proves they meet that core principle.
Makes sense. What else? It sounds like this form is huge.
It keeps going. They need details of all their branches or different company units, especially if they're all going to be under one common trust. They need proof those units agree. Full details of every single trustee. Names, positions, contact info.
The people managing the trust fund.
Yep. Also, the date the trust deed was officially created. Which type of exemption they want the whole company, 17(1) or just a class of employees. Info on whether the trust is recognized under the Income Tax Act.
Okay. Still more.
Still more. Details on contribution rates, the interest rate they plan to pay, proof they've been paying all their regular EPF, pension scheme, EPS, and insurance scheme, EDLI dues properly up to this point.
So their track record matters.
Big time. They need the date they last gave employees their annual PF statements, a declaration about the company's financial health, any losses in the last 3 years, any capital erosion.
Checking if the company itself is stable.
Right. And confirmation, if needed, that PF contributions are already going to their own board of trustees from the date they intend the exemption to start.
Okay, feels like we've covered the company side. What about the employees in all this?
Crucial point. The application must confirm they have the consent of the majority of employees. The employees have to agree to this shift.
So it's not just a top-down decision?
Nope. Majority consent is required. And finally, wrap it all up with audited balance sheets, one for the company itself, one for the proposed trust, plus confirmation that any funds they already have are invested according to the government's rules.
Those government investment patterns, right?
Yeah.
To keep the money safe.
Precisely. It's all about secure, regulated investments.
Okay, wow, that is a mountain of paperwork and preparation. So they've gathered all this. Where does it go? Who do they send it to?
It all gets submitted, preferably online, the SOP says, to the local EPFO regional office, the RO that covers their company.
And that kicks off phase 2, the RO scrutiny.
You got it. Phase 2 begins. The RO gets the package. First thing, within about 2 weeks, they should acknowledge they have it and do a quick check or all the basic documents there. They assign it a unique ID code too. Something like JER Region Case Number YourGuffed.
What if something's missing? Or the RO needs more info?
They'll write to the company saying, hey, we need X, Y, and Z, and give them 2 weeks to provide it.
Only 2 weeks? That seems tight.
It is. If the company doesn't respond, the RO sends one reminder giving them another final 2 weeks.
And if they still don't respond after the reminder?
Then the RO can basically say, okay, you're not cooperating, and just treat the company as unexempted, meaning they have to comply with the standard EPF rules as usual. The application effectively stalls.
So you really need to be on the ball with responding. Assuming they do provide everything and the application is complete, what happens then at the RO?
Then comes the deep dive from the RO, detailed scrutiny. They'll really examine the comparative benefits table. Are the benefits truly comparable or better? They'll go through Appendix A, line by line, are all the conditions for exemption being met.
They double check everything.
Everything. A really key task for the RO is to officially certify that comparison of benefits using a specific format. And they also have to fill out this detailed 16 points checklist that comes from the Ministry of Labor and Employment. It covers all the critical compliance points.
So the RO is like the first major checkpoint, making sure everything's solid and the employees are protected.
Exactly. They're the first line of defense, you could say. If they find problems, things that don't meet the requirements, they'll note their reasons for potentially rejecting it and send that up the chain. But if everything looks good,
If it passes muster.
then within 10 weeks of getting the complete application, the RO packages it all up, the original application, all the documents, their certification, that 16-point checklist, and Form GE2.
Form GE2, what's that?
GE2 is basically the RO's summary report and recommendation. It says, we've checked it, here's what we found, we recommend approval or rejection, and they send this whole bundle up to the next level, the zonal office, or ZO.
Okay, on to phase 3. The zonal office. What's their job here?
The zonal office gets the file from the RO. Their main task is to look at the overall soundness of the proposal. They do another layer of review and certify if they think the establishment is fit for exemption.
A second opinion? Sort of.
Kind of, yeah. A higher level check. They need to do this pretty quickly within 15 days of getting it from the RO. Then they forward everything, the application, the RO's stuff, their recommendation certificate using Form GE3, and a draft agenda item up to the head office.
Okay, now you mentioned something about relaxation orders at the zonal level. What was that about?
Ah, yes. The head person at the zone, the ACC zone, has this power under Para 79 of the EPF scheme to grant certain relaxations from the standard rules in specific justified cases. It's a bit of a side path from the main exemption process, but it could be relevant for some companies applying for exemption. Something to be aware of.
Interesting. Okay, so assuming no side paths, the file reaches the EPFO head office. Phase 4 begins. What happens there?
Right. At head office, it lands with the ACC Exemption Division. They do their own evaluation. Then, with the top boss's approval, the Central Provident Fund Commissioner, they prepare it as an agenda item for a specific committee.
Another committee.
Yep, the Exempted Establishments Committee, or EEC. This isn't a legally required body, but it's set up by the main board, the Central Board of Trustees, CBT, specifically to handle these exemption requests. Think of them as the specialists who do the detailed review for the main board.
So the EEC digs into the details.
Exactly. They review everything, the application, the RO and ZO recommendations, all the documents. They discuss it and form their own view, should this exemption be granted or not, and why.
And what happens with the EEC's recommendation?
Their views get formally presented to the big boss, the Central Board of Trustees, the CBT. The CBT is the highest authority within the EPFO itself.
Okay, so the CBT gets the final say within EPFO.
They make the final recommendation. They look at what the EEC said, consider everything, and then they decide what they recommend. This usually happens within about 4 weeks of the file arriving at head office. Their recommendation is put into Form GE4.
So the CBT makes its recommendation on Form GE4. Is that the final approval? Are they done?
Almost, but not quite. The ACC exemption at head office takes that Form GE4, bundles it with all the original documents again, and sends the entire package to the appropriate government.
The government. Which government?
It depends on the company. It could be the central government in Delhi, or it might be the state government where the company is based. The EPF Act defines who the appropriate government is for different types of establishments. They make the final decision.
Ah, so the EPFO recommends, but the government gives the final yes or no.
Exactly. And the SOP notes that follow-up at the government department is really important at this stage to keep things moving.
It really is a journey with multiple layers of checks and approvals. So let's say the government approves. We're in phase 5, post-exemption. What happens then?
Okay, green light. The head office then helps get all the past PF money transferred from the EPFO over to the company's brand new trust.
How does that transfer work? Do they send over stocks and bonds?
Nope. The SOP is very clear. The transfer is 100% in cash. No securities. Just cash. This gives the new trust liquid funds to start managing things right away.
Makes sense. And once the money is transferred, does the EPFO just step back, let the company run its own show?
Not quite. There's ongoing monitoring.
Yeah.
The RO, the ZO, and the head office all keep tabs on these exempted trusts.
How often?
The SOP says fortnightly reviews at the RO and ZO level and monthly or quarterly at the head office. They use specific reports, detailed in Form GE5, to track how the trust is doing. Is it complying? Is it paying the right interest, settling claims properly?
They're always watching.
Pretty much. The goal is to eventually have an online system for all this reporting, but for now, it's these regular checks and reports. It ensures the trust keeps meeting that not less favorable standard and follows all the rules. The oversight doesn't just disappear.
Okay, that's clear. We've thrown around a lot of acronyms and roles. Maybe we can quickly recap the key players involved.
Good idea. So you've got the employer, obviously, who wants the exemption. They set up a board of trustees, BOT, to manage the fund. The employees are the beneficiaries. and their consent is needed.
Right, and within the EPFO.
You start with the Regional Provident Fund Commissioner, RPFC, at the regional office, the first point of contact and scrutiny. Then the ACC zones oversee the regions and do the zonal review. At the top, the ACC exemption at head office manages the process overall. You have the Exempted Establishments Committee, EEC, doing the specialist review,
For the main board.
which is the Central Board of Trustees, CBT, the highest body in EPFO making the recommendation. And finally, the appropriate government, central or state, gives the ultimate approval.
Got it. And those forms GE1 to GE5, just quickly again.
Sure. GE1 is the company's application. GE2 is the RO's recommendation to the ZO. GE3 is the ZO's recommendation to head office. GE4 is the CBT's recommendation to the government. And GE5 covers all the ongoing monitoring reports.
Perfect. So someone listening, maybe thinking about this for their company, what's a realistic timeline? Are we talking weeks, months, years?
Definitely months, based on the time frames in the SOP. You've got a company's prep time first, then maybe 2.5 months or so at the RO, another couple of weeks at the ZO, then maybe another month and a half, perhaps longer, at head office and waiting for the government. So realistically, you're probably looking at, 4 or 5, maybe 6 months minimum, assuming everything goes smoothly.
Not a quick process then.
Not at all. It needs planning.
Something else interesting you mentioned was that this SOP cancels out all the old rules and circulars on this. Why is that significant?
Yeah, that's an Annexure I. It lists all the old stuff this SOP replaces. It's important because it shows the EPFO is trying to clean house, basically. Consolidate everything into one clear, up-to-date document. So company's EPFO staff is working from the same current rule book. It avoids confusion.
A fresh start on the rules. And we talked about the conditions of exemption earlier based on that Appendix A. Anything more to stress about those?
Just how absolutely critical they are. Appendix A is the rule book for running an exempted trust, day in, day out. It covers everything. How the Board of Trustees must function, enrolling employees correctly, contribution rates, paying the right interest, how quickly claims must be settled, the exact rules for investing the money, strictly government-approved patterns only.
So, very detailed.
Extremely detailed. Mandatory audits, specific promises or undertakings that trustees have to make. The list is long. And the key thing is, fail to comply with any of these ongoing conditions, and the government can cancel the exemption.
So getting exemption is hard, but keeping it also requires constant vigilance.
That sums it up perfectly.
Okay, so wrapping this up, the big takeaway feels like getting EPF exemption is possible, but it's a really detailed, multi-stage process. It needs a lot of upfront work, tons of documentation, and a serious commitment from the company to follow the rules long term.
Exactly. And threaded through absolutely everything is that core principle.
Right.
Employees must be no worse off. Their benefits under the company trust have to be not less favorable than under the standard EPF. That's the promise from start to finish and beyond.
This has been super helpful, really demystifying that SOP. For listeners wanting to think more about this, maybe some questions to ponder are, how exactly do they measure not less favorable? What are the common pitfalls or reasons applications get rejected? And what does the day-to-day running of an exempted trust actually involve for the company?
Yeah, those are great follow-up questions. Because it really boils down to this balance, doesn't it? The balance between giving companies some flexibility in managing funds and the absolute need to make sure employees' retirement savings are safe and secure. Hopefully this deep dive gave everyone a much clearer picture of how that balance works in the world of EPF exemptions. You know how sometimes you run into a topic that just sounds incredibly dense, almost like it's written in code? Well, today's deep dive is tackling one of those. The whole process around how and why the government might cancel the special permission some companies get to manage their own employees' provident fund, or PF.
Right, the PF exemption.
Exactly. And you, our listener, sent over some really interesting material on this. We've got a standard operating procedure, some detailed reviews, a study guide, even FAQs.
A good mix of sources.
Yeah, so our mission today is to cut through that complexity, pull out the crucial bits, and understand why this matters for workers' financial security.
Definitely. We'll treat these documents like a guide, really, aiming to make this whole intricate system, well, a bit less intricate. It's all about protecting those PF contributions.
Okay, good plan. So maybe let's start right at the beginning. What exactly is this PF exemption? Why wouldn't a company just use the regular government PF scheme?
That's the perfect place to start. Getting an exemption isn't automatic. It's not a right. The sources really stress that it's a privilege.
A privilege, okay.
Yeah, it's granted mainly to companies that are, financially solid. They have to demonstrate they can offer PF benefits that are just as good as the government's EPF scheme, or maybe even better.
So it's like a sign of trust that the company is stable enough to manage these important funds itself.
Exactly. It's like saying, okay, you seem financially robust. You can handle this responsibility for your employees.
But you keep using that word privilege, which makes me think it's not permanent. It can be taken away.
Precisely. Because it's granted based on meeting and continuing to meet certain conditions. If those conditions lapse or maybe weren't followed properly from the start, that privilege can be withdrawn.
And that's where the EPFO comes in, the Employees Provident Fund Organization.
Correct. They are the regulator here. They're the ones keeping an eye on these exempted establishments.
Right. So what power does the EPFO actually have when it comes to canceling these exemptions?
Well, under the EPF Act, specifically Section 17, subsection 4, the EPFO is empowered to cancel an exemption if the establishment violates the conditions it was granted under.
Okay, so they have the legal teeth.
They do. But it's interesting how the sources frame it. They clarify that cancellation is seen as withdrawing that privilege we talked about. It's not treated as a penalty under a different section, Section 14.2a, which deals with actual offenses.
That's a subtle difference. So it's more like you don't meet the requirements anymore rather than you're being punished.
Exactly. It's about suitability to continue managing the fund independently.
Okay, so these companies, the exempted ones, they have a rule book they need to follow, right? What kinds of rules are we talking about?
Absolutely. There are specific conditions they agree to. These are typically outlined in the EPF scheme itself. There's an Appendix A to Para 27A I mentioned, and also in the specific notification letter that granted them the exemption.
Got it.
Our study guide points out that sticking to these conditions is crucial. Any violation can basically trigger the cancellation process.
And what sorts of violations are we talking about? What are the red flags?
There's quite a list, actually. A really big one concerns the company's financial stability.
Makes sense.
Yeah, if an establishment reports financial losses for 3 consecutive years, or if its capital base gets significantly eroded, that's specifically mentioned as condition number 25 in the rules. It actually triggers a mandatory withdrawal of the exemption.
Mandatory.
Yeah.
So no second chances there.
Pretty much. The thinking is if the company is struggling that badly, the employees' PF funds could be at risk.
Definitely a major concern. What else? What other triggers exist?
Changes in the company's legal status are another big one. Things like mergers, acquisitions, demergers. If the fundamental structure changes, that's condition number 29, and it also leads to mandatory revocation.
Okay.
The company has to report that change promptly to the Regional Provident Fund Commissioner, the RPFC.
RPFC. Got it.
Then there are issues around how the PF fund itself is managed, like not following the prescribed investment pattern for the funds over an extended period.
So, mishandling the money.
Essentially, yes. Or even more, basically, not holding the investments, the securities, in the actual name of the Provident Fund Trust. Or not having a proper DMAT account, an electronic account, in the trust's name. That's condition number 18.
Wow. Okay, so it's not just about having the money, but managing it properly, transparently by the book.
Exactly right. Other triggers include things like defaulting on transferring PF contributions, trying to evade covering eligible employees under the scheme, even failing to file their online returns for 3 months running can start the process.
3 months seems quite specific.
It is, and also, if they try to amend the rules of their own trust without getting the RPFC's approval first.
Trying to change the game rules unilaterally.
Pretty much. Oh, and there's condition number 19, which is quite important. It says if an establishment closes, goes into liquidation, or has its exemption canceled, the banks or institutions holding the trust's investments must transfer those investments to the Central Board of Trustees, the CBT.
The main government body.
Right, but only if the RPFC specifically requests them to do so. It's like a safety net mechanism.
Okay, it sounds like a lot of potential pitfalls. Now, how does the EPFO prioritize? I mean, some of these sound more serious than others. I think I saw mention of a priority matrix.
You did, yes. The SOP details this priority matrix, Form CE6. It helps categorize violations into 3 levels, A, B, and C.
A, B, C. Okay.
Category A is for the most critical violations, the stuff that triggers immediate action action and very likely leads to cancellation. Think about those mandatory triggers we just discussed, the consecutive losses, the change in legal status, not holding securities correctly.
Yeah, the really big ones.
Yeah. When a Category A violation is found, the RPFC is supposed to issue a formal show cause notice, that's Form CE1, immediately, basically asking, why shouldn't we cancel your exemption?
Okay, straight to the point. What about B and C?
Category B violations are serious but perhaps fixable. The company typically gets around 15 days to rectify the issue. This might include findings from an audit or delays in settling employee PF claims, things like that.
And if they don't fix it?
Then the cancellation process can be initiated. And importantly, repeated Category B violations can accelerate that process. They don't get endless chances.
Gotcha. And Category C?
Category C is less severe initially. It's more about advising vigilance, maybe minor procedural issues. But, and this is key, if a Category C violation isn't rectified and keeps happening, say, 3 consecutive times, that can also escalate and lead to cancellation proceedings. An example given is failing to provide a written undertaking to follow the exemption rules.
So even the smaller stuff can add up if ignored. It feels like a tiered warning system.
That's a good way to put it. It focuses attention on the biggest risks first, but keeps track of everything else too.
Right. So let's say a violation occurs, it gets categorized, maybe it's serious, Category A, or an uncorrected B. What happens next? Who does what in this cancellation process?
The standard operating procedure, the SOP, is very clear on roles and responsibilities. It generally starts with the Regional Provident Fund Commissioner, the RPFC we mentioned.
The local authority.
Exactly. They identify the violation, perhaps through returns, audits, or inspections. They then kick off the process, usually by issuing that show cause notice, Form CE1. It typically gives the company 15 days to respond.
Okay.
The RPFC might also decide a third-party audit is needed to really dig into the company's financial health or the trust's operations. This audit is actually mandatory in some cases, like those Condition 25 cancellations due to losses. It needs to be done within 30 days of issuing a different notice, Form CE9.
And what if the company just holds up its hands and says, yeah, we messed up?
Good question. If the employer admits the lapses, the RPFC has the power to step in and basically take over the administration of the trust immediately to safeguard the funds.
Wow, okay, so the RPFC has significant power at the start. What's the next step if they decide cancellation seems necessary after the company responds or doesn't respond satisfactorily?
If cancellation is the recommended path, the RPFC prepares a comprehensive package called the Draft Agenda. That's Form CE Bait 2. It includes everything.
Yeah.
The original exemption notification, the show cause notice, the company's reply, reports on the violations, the financial health assessment, any audit reports, and even a draft of the government show cause notice, Form CE3.
That sounds like a lot of paperwork.
It is. It needs to be thorough. This entire package has to be forwarded to the next level, the zonal office, within 30 days of receiving the company's response to the initial notice.
Okay, and does the RPFC do anything else?
Yes, they also handle slightly different scenarios. For instance, if an establishment is operating under Para 79 of the scheme but doesn't have a formal exemption letter, the RPFC uses Form CE1R to withdraw relaxations and direct transfer of funds. They also formally notify companies about mandatory withdrawals under Condition 25 using Form CE9 or revocations under Condition 29 using Form CE10. And in certain situations, like related to Condition 19, they issue directions to the banks holding investments using Form CE11. Oh, and notably, the RPFC is also the authority for canceling exemptions for individual employees under Section 17 too.
Okay, the RPFC is definitely a key player, handling a lot of the groundwork and initial actions. What happens when the case reaches the zonal office, the ZO?
The zonal office acts as a review point. They scrutinize the draft agenda, Form CE2, sent up by the RPFC, make sure the case is solid, documentation is complete, then within another 30 days they forward it with their own recommendations to the head office using Form CE4.
So another layer of review.
Yes. The ZO also coordinates with state governments if the original exemption was granted by them, which sometimes happens, and they handle the technical request to eventually remove the establishment's online return filing link.
All right, so the file moves up the chain to the head office, HO. What's their role? This seems like where the final decision-making starts to happen.
Pretty much. The head office takes the agenda and presents it first to a specialized committee, the Exempted Establishments Committee, or EEC.
EC, okay.
And then, based on the EEC's input, it goes to the main governing body, the Central Board of Trustees, the CBT. The goal is to get complete agendas tabled quickly, ideally within 30 days of receipt or at the very next EEC meeting.
And what does the CBT do? recommend cancellation?
They review the case and make a recommendation. Once the minutes of the CBT meeting are finalized, the head office has 15 days to forward that recommendation to the appropriate government, usually the central government using Form CE-5.
Okay, so HO packages it up for the government.
Yes, and they also monitor the whole process, making sure the final cancellation notification actually gets issued by the government. They process the link removal request from the ZO, and importantly, they double-check the reported past accumulations figures with their own investment and banking division.
So a final check on the money involved, and then it's the government that issues the final cancellation order.
That's right. The appropriate government makes the final decision and issues the cancellation notification in writing.
Okay, so the notification arrives, the exemption is officially canceled. What happens then? What are the immediate consequences?
Right, so the establishment is now unexempted. It's back under the main EPF scheme run by the government. The biggest immediate task is transferring all the accumulated PF funds, the past accumulations, or PA from the company's trust to the Central Board of Trustees, the CBT.
And is there a deadline for that?
Yes, a strict one. It has to be done within 30 days of the cancellation order. This is governed by Section 17(5) of the Act and Para 28 of the scheme.
30 days. Seems quick for potentially large sums.
It's meant to ensure the funds are secured promptly. The RPFC also publishes a notification in the official government gazette stating that the employees of this now unexempted company are covered by the central board.
Okay, making it official.
And that online return filing link we mentioned, it gets deactivated. Both the head office and the regional office monitor closely to make sure the PA transfer actually happens. If the company fails to transfer the funds, further action can be taken against them.
Right, enforcement.
And remember, Condition 19. If that applies, the RPFC formally instructs the depository participants, the banks or institutions holding the investments, to transfer those directly to the CBT.
So multiple ways to ensure the money gets where it needs to go. It sounds like a complete handover back to the government system.
Exactly. The priority is securing those employee contributions.
Now, the SOP, the guide, also mentioned exceptional circumstances. What kind of situations does that cover?
These are basically for scenarios that don't fit the standard flow perfectly. For example, that Condition 19 situation might require the RPFC to deal directly with the investment holders, the depository participants.
Okay.
If an establishment has already closed down before or during the process, the focus shifts mainly to facilitating the transfer of the past accumulations. There might also be rare cases where, due to urgency, the cancellation proceeds even if the third-party audit isn't fully complete yet.
Really?
Yes, but only with strong justification recorded, and the audit would still need to happen later during the fund transfer stage. The rules also outline a process if a company voluntarily decides it wants to surrender its exemption.
Ah, okay. So they've tried to cover various non-standard situations too. Finally, how is this whole system kept in check? Is there ongoing monitoring?
Yes, absolutely. There's multi-level monitoring built in. The RPFC at the regional office level reviews the status of these cases monthly. The additional central commissioner at the zonal office level also does a monthly review.
And at the top?
At the head office, the Central Provident Fund Commissioner, the CPFC, conducts a quarterly review. There are also specific monthly reports, Forms C7 and CE8, that flow from the regional offices up to the head office tracking progress.
So regular checks at every level.
Right. And while a lot of this currently relies on these procedures and communication like email, the documents mention plans to develop an integrated online system to process these cancellation cases driven by that priority matrix logic. That should streamline things further.
An online system makes sense for efficiency. Okay, so wrapping this up, it really seems like PF exemption cancellation, while complex, is a very structured process. It's not arbitrary.
Not at all. It's designed specifically to protect workers' Social Security when an exempted company fails to uphold the responsibilities that came with that privilege of managing its own PF fund.
Yeah, you can see the steps clearly. Now the triggers, the different roles of the RPFC, ZO, HO, the government, that priority matrix ensuring focus.
And crucially, that final step of transferring the past accumulations to secure the employee's money. That's the ultimate goal when an exemption is withdrawn.
This has been incredibly helpful in demystifying that process. So thinking about everything we've discussed, all the potential triggers, the checks and balances, here's a final thought for you, our listener. What do you think are the key indicators, the real signs you might look for that suggest an exempted PF trust is genuinely stable and compliant for the long run? Something to mull over. Thanks for joining us for this deep dive.
You know how sometimes things like employee benefits seem incredibly complicated, like just a maze of rules?
Absolutely. It can feel overwhelming.
Well, today we're trying to sort of distill one part of that. We're doing a deep dive into something called the surrender of EPF exemption. Sounds technical, but we want to make it clear.
Exactly. So EPF exemption, that's basically when certain companies get permission to manage their own employees' provident fund through a private trust instead of the main employee provident fund organization, the EPFO.
Right.
And what we're looking at today is what happens when those companies decide, voluntarily mind you, to hand that job back to the EPFO.
And this isn't just us talking off the cuff. We've got the official document, the actual standard operating procedure, or SOP, from the EPFO. It's dated December 4th, 2023.
That's our main guide. Plus, there are some helpful supporting docs that explain it further, even some that quiz you on it. Things like EPF exemption surrender, a standard operating procedure, and similar briefings.
So our mission here is to pull out the really important bits from all this, explain it clearly, maybe uncover a few surprising details along the way. We want this to be almost like a stand-in for reading those dense documents yourself.
A clear, understandable guide to the whole surrender process. That's the goal.
Okay, let's jump in. First big question. Why? Why would a company go to the trouble of setting up its own PF trust only to later decide to give it up? Seems like a U-turn.
Well, the SOP itself actually gives two main reasons. The first one is that establishments, they sometimes find it hard to match the level of benefits that the main EPF scheme offers.
Ah, okay. So the EPFO might just offer a better deal overall.
Potentially, yes. Because of its sheer size and central management, the EPFO often has advantages, maybe in investment returns or just administrative ease. And actually, some data suggests smaller companies especially find running their own trust quite burdensome administratively.
That makes sense. The admin overhead must be significant for smaller teams. What's the other reason mentioned?
The second key factor is, interestingly, a growing trust in the EPFO itself.
Really? So more confidence in the public system.
Yeah, it seems both employers and employees feel a certain security with the EPFO managing things directly. It's built reputation. And look, it's important to stress this is voluntary surrender we're talking about.
Right, not the EPFO stepping in because the company messed up.
Exactly. That's a whole different scenario where the EPFO cancels an exemption for non-compliance under Section 17(4) of the Act. This is the company choosing to come back.
Okay, so this whole chosen path is laid out in this standard operating procedure, the SOP. You mentioned the date, but when did it officially come into force?
This specific SOP was issued on October 30, 2023, and it's key to know it overrides any previous instructions or guidelines on this topic. This is the current playbook.
And the main point of having this new SOP, is it just about updates, or does it aim to fix specific problems?
It's really about standardization. The aim is to make the whole process uniform, clear up what documents are needed, the timelines involved, solve operational hiccups, and set up proper monitoring.
So clarity for everyone, especially the company surrendering?
Precisely. And also ensuring the EPFO handles these requests efficiently within set timeframes, making the transition smoother, really.
All right, so let's walk through it from the company's perspective. They decide, okay, we're doing this. What's the very first step?
The first thing they need to do internally is decide on a prospective surrender date, a target date in the future when they want this handover to officially happen.
Needs some planning, I imagine.
Definitely, because a lot needs to happen before that date.
Okay, date decided. What's the first concrete action item?
A really crucial early step is preparing a detailed list, a list of all beneficiaries of their private PF trust.
Not just current employees.
No, everyone who still has funds in that trust. And this list needs full KYC details. Know your customer for every single person, accurate right up to that proposed surrender date.
Wow, that sounds like it could be a massive task, especially for older companies. What comes next for the establishment?
Often, yes. The next step involves getting a third-party audit done.
An independent check.
Exactly. They arrange this, usually in consultation with the local Regional Provident Fund Commissioner, the RPFC. It's an audit of the trust's funds to check its financial health and make sure the amount being transferred is accurate.
And who pays for this audit?
The employer bears the cost of that audit.
Okay, so a financial health check. What about past issues, like old employee complaints?
Good point. The establishment has to commit formally to resolving any outstanding employee grievances that relate to the period before the surrender.
Yeah.
They can't just pass the buck on old problems.
Right, clean slate needed.
Yeah.
So prep work done, audit may be done, grievances handled. How do they officially kick off the process with the EPFO?
The formal process begins when they submit an application. There's a specific form, Form SE1.
SE1, got it.
This application is technically addressed to the appropriate government, could be central or state, but it's submitted via the RPFC.
Okay, so the regional office is the gateway.
Yes, and they need to send it both by email and registered post. Importantly, this has to be done at least 30 days before their target surrender date.
Only 30 days. Seems tight after all that prep. What documents have to go with this Form SE1? It must be quite a package.
It is. It's pretty comprehensive. They need a signed undertaking from the employer, basically promising to cover any financial losses during the transfer.
A guarantee.
Yes. They also need a copy of the original notification that granted them the exemption in the first place. Proof they were allowed to run their own trust.
Makes sense. What else?
A certified copy of the resolution from their board of trustees, the one where they formally decided to surrender the exemption, and it must state that proposed date.
Okay.
Then, compliance audit reports specifically, the observations and the company's replies for the last 3 years.
Gives the EPFO a track record.
Exactly. And then detailed financial information. The total size of the trust's funds, the corpus, including audited balance sheets. If it's a group trust, they need this for all participating units too. Plus, a breakdown of all their investments, securities, everything.
Wow. Complete financial transparency and compliance history. Okay, they submit this big package. What happens then?
After the RPFC reviews this and gives them provisional permission to act like a regular unexempted company, that permission comes in Form S5, another clock starts ticking.
Another deadline.
Yes. Within 30 days of getting that Form SE5 permission, the establishment absolutely must submit something called a past accumulation statement, or PA statement, to the regional office.
Past accumulation statement. What's in that?
That details every member's account, balance contributions, interest, everything right up to the surrender date. And hitting that 30-day deadline is critical. Miss it, and there are penalties.
Penalties. Okay, noted. Now, the practical bit, moving the money. How do they actually transfer potentially millions in assets?
Well, the SOP outlines different procedures for different asset types. For actual cash, initially, it's transferred via demand draft.
Demand draft? Really? Seems a bit 20th century.
It does, yeah. But the SOP mentions this is the method, at least until a fully online system might be developed. It's payable to the regional office. Secure and documented, I suppose.
Okay, demand drafts for cash. What about other investments, like government schemes?
Right. For funds in the Special Deposit Scheme, SDS, it's more involved. The establishment has to coordinate directly with the bank holding the deposit. They need to keep the regional office in the loop, too.
So more direct coordination needed there.
Yes, they applied to transfer the SDS account balance to the EPFO's Central Board of Trustees, specifically to the EPFO's main SDS account at SBI Mumbai. They also need to provide a full statement showing all deposits and interest earned right up to the cancellation date. It's a bit of a three-way coordination. Company, bank, EPFO.
Sounds like it requires careful handling. And what about things like stocks or bonds the trust might hold? Permitted securities?
For those, the SOP says the establishment needs to contact a specific officer at the Unit Trust of India, UTI. UTI handles the transfer process for these kinds of securities.
Okay, so specific contacts for each asset class. What if some employees don't have their digital ID, like the UAN, sorted out?
That's a really important point. If any employees lack a universal account number, the UAN, or if their details aren't complete for generating one, the employer is responsible for providing authenticated details to get those UANs created.
So the onus is on the employer to fix data gaps.
Absolutely. The UAN is key for tracking everything. And ultimately, the chairman of the board of trustees is held accountable for the accuracy of that whole past accumulation statement, member details, balances, everything.
Huge responsibility there. You mentioned earlier something about a simpler process for individual exemptions. How's that different?
Yes. If a company got an exemption just for one specific person, or maybe a very small defined group, under a different section of the Act, Section 17.2 with Para 27 of the scheme, the surrender is more direct.
Simpler how?
The employer can basically apply straight to the RPFC. They still need documents, like a certified statement of that individual's account, their UAN, Aadhaar, PAN, bank details, relevant compliance audits for that member, the latest return filed for them, and a final statement of their balance and interest. But it bypasses some of the larger steps for a full establishment surrender.
Okay, a more streamlined path for those specific cases. Now, let's flip the coin. What's the EPFO doing while the company is going through all this? The regional office seems to be the first stop.
Correct. The RO, the regional office, plays a critical role. First, they do an initial check of that Form SE1 application package.
Just a quick look over.
Sort of. If they spot anything missing or incomplete right away, they have to return it to the company within 7 working days.
7 days? That's fast. Helps avoid delays, I guess.
That's the idea. Get it corrected quickly. If the application looks complete initially, the RPFC then dives deeper, verifying all the details against the EPFO's own records for that company.
Checking everything matches up.
Exactly. And this is also the stage where the RPFC might decide, we need that third-party audit we talked about.
If they feel it's necessary for a clear financial picture.
Precisely. They have the discretion to mandate it then.
Okay, so initial checks, verification, maybe an audit request. What's the next output from the RO?
If things look okay at this point, the RPFC issues that crucial Form S5.
Yeah.
That's the provisional permission for the company to start acting like an unexempted establishment. It basically says, okay, you can start following the regular EPF rules now, but the final surrender approval is still pending.
Provisional permission. So they're in the system, but not fully signed off yet. What about managing the money transfer at the RO?
The RO is central to that. They oversee receiving the past accumulations, that money detailed in the PA statement, making sure it gets credited to the right individual member accounts. They use Form SEs for tracking this.
And you mentioned KYC helps speed things up.
Yes. The SOP notes that accounts with complete, verified KYC details are likely to get credited faster, a good incentive for everyone to keep their details updated. The RO also manages the logistics of the different asset transfers, coordinating the demand drafts for cash, liaising about the STS funds, working with UTI for securities. They're the hub.
Sounds like they're juggling a lot administratively and financially. What else falls under the RO's remit?
They also formally start processing the surrender proposal itself. This has to begin within 30 days of the company starting at unexempted compliance after getting Form SE5. If the RO finds any issues during this deeper review, they have to flag them to the employer within 7 days. They might even call meetings with the company reps to sort out tricky bits.
Okay, ongoing communication. And what's the final piece the RO produces to move the whole thing up the chain?
The RO prepares a detailed draft agenda. This uses Form SE2. It summarizes everything the companies request, the financials, the compliance history, their assessment, and recommendations. This whole package then gets forwarded to the zonal office.
Right. And one more thing for the RO, something about a gazette?
Yes. Much later, once the entire process is finished and the exemption is officially canceled by the government, the RO has the task of issuing a notification in the official gazette. That's the public announcement under Para 28.1 of the EPF scheme, confirming the trust funds are now with the EPFO's central board and the employees are full EPF scheme members.
Okay, so the RO sends the draft agenda up to the zonal office, the ZO. What's their job? Another layer of checking.
Pretty much, yes. The ZO acts as a review layer. They get the draft agenda, Form SE2, from the RO. Their main job is to meticulously review it, check the facts, certify everything is accurate, and then forward it.
Forward it where?
To the head office. They add their own recommendations and send the certified agenda onwards using Form SE3. And they have a deadline, too, within 30 days of receiving it from the RO.
Another 30-day window. Seems these timelines are really built in. So finally it lands at the head office. What's the process there?
It gets quite high level at the head office, HO. First, the Specialized Exemption Division thoroughly examines the agenda that came up from the zonal office.
Expert review.
Yes. Then, the proposal goes before the Exempted Establishments Committee, the EEC.
A dedicated committee just for this.
Seems so. They review it in detail. Their recommendations then go to the top body, the Central Board of Trustees, the CBT for ratification.
So exemption division, then EEC, then the main CDT, a multi-stage internal approval. What happens after the CBT approves it?
Once the CBT gives the green light, the head office packages everything up the full proposal, all the recommendations from the EEC and CBT, and sends it off to the appropriate government. And they have to do this pretty quickly, within 15 days of the CBT approval.
15 days, that's quick. Does the head office wash its hands of it then, or do they follow up?
No, they stay involved. The HO is responsible for actively chasing, following up with the appropriate government to make sure that final formal cancellation notification actually gets issued. They coordinate with the zonal offices on this too.
So the EPFO does all this internal review, but the final legal step is with the government.
Exactly. After all the EPFO levels have signed off, the power to actually cancel the exemption lies with the appropriate government. They issue the final formal notification.
What's that notification technically called?
It's issued under Section 17(4) of the EPF Act. That official notification is the legal act that formally cancels the exemption and concludes the entire surrender process.
We've mentioned timelines a few times. It sounds like the SOP puts a real emphasis on speed and deadlines.
It really does. There are clear time limits specified for almost every stage, like the RO's initial 7-day check, the 30 days they have to start processing the proposal, the ZO's 30-day review, the HO's 15 days to send it to the government after CBT approval. It's all structured to keep things moving.
And is anyone watching to make sure these deadlines are actually met? A monitoring system?
Oh yes, absolutely. The SOP sets up monitoring at multiple levels. At the head office, there are monthly reviews by the additional Central Commissioner for Exemptions and quarterly reviews by the Central Commissioner himself.
Okay, top-level oversight.
Then, at the zonal and regional levels, the respective commissioners hold reviews fortnightly every 2 weeks. Plus, the zonal offices have to send monthly progress reports up to the head office, tracking all the pending surrender cases. It's quite a robust system to prevent things from getting stuck.
Built-in accountability. Good to hear. We've thrown around a lot of form numbers, SE1, SE5, etc. Could you just quickly recap the main ones and what they're for, just to make it super clear?
Sure thing. Let's run through the key ones. Form SE1. That's the company's initial application to surrender.
Okay, the starting point.
Form SD5.
Here.
This is the permission from the RPFC, allowing the company to start acting as unexempted, provisionally.
The green light to begin transition.
Form SE6. That's the past accumulation statement the company submits, detailing all the money being transferred.
The financial breakdown.
Then forms C2 and SE3. These are internal EPFO forms. SE2 is the RO's draft agenda sent to the ZO, and SE3 is the ZO's format for forwarding it to the head office.
Internal processing forms.
Right. Form SE4. This is what the head office uses when they send the final approved proposal to the appropriate government.
The final submission package format.
And Form S7. That's specifically for transferring the special deposit scheme funds we talked about.
Got it. That's a helpful checklist of the key forms. So, wrapping up this deep dive, what are the main things we should take away about surrendering EPF exemption?
I think the biggest takeaway is that while it's a major decision for a company, it's now a very clearly defined process. It's driven by the company's choice, guided step by step by this comprehensive SOP, and involves careful checks at multiple levels within the EPFO before the final government decision.
And the reasons behind it often boil down to, well, the practicalities of matching EPFO benefits and maybe a growing trust in the public system's stability and efficiency, right?
Right.
Especially compared to the burden of running a private trust.
Exactly. It suggests a potential shift towards valuing the security and standardization the EPFO offers. And the detailed procedures and monitoring outlined in the SOP show a real commitment to making that shift smooth and accountable.
It's definitely unpacked a complex topic. It's more involved than you might first think, but that SOP really does seem to provide a roadmap, makes it less daunting.
It does. And maybe that leaves us and our listeners with a final thought to chew on. What does this trend of companies voluntarily choosing to come back under the EPFO umbrella really signal about the future of retirement savings? Does it say something about trust in public versus private management of these essential funds? And what other questions does it raise about employer responsibilities and employee security in this whole area? Something to think about.
Welcome to the Deep Dive. We're here to take complex topics and, well, make them clear and understandable.
That's the plan.
And today, our mission is pretty specific, but really important. We're going to thoroughly walk through the online return filing process for establishments that are exempted under the Employees Provident Fund scheme in India.
Right. Think of this as your audio guide, basically. We want to cover everything you'd find in the official manuals, the guides, the FAQs.
All that dense material.
Exactly. We've gone through it all, the return manuals, online guides, briefings, even study materials to pull out the essential bits so you get the full picture without, having to read pages and pages yourself.
And this is super relevant if you're working with a PF trust or maybe an establishment that manages its own employee funds because it has an exemption.
Absolutely. Knowing how this online system works isn't just recommended practice. It's often a core requirement.
Okay, so how are we structuring this?
We're going to follow the system's own structure. It's built around 6 modules, A through F. If we understand each one, the whole process should make a lot more sense.
Makes sense. Let's dive right in then. Module A, establishment details. This sounds like the basics.
Precisely. It's the foundational info about your exempted establishment.
Okay, what kind of fields are we talking about?
Well, you've got the establishment ID that actually pops up automatically when you log in, so that's easy.
Ah, convenient.
Then you'll input the name, the address, the PAN number, type of ownership, and your main business activity. And critically, the details about your exemption.
The exemption itself, like what?
Yeah, the specific section or paragraph number that grants the exemption, the order or notification details number, date who issued it, and very importantly, the date the exemption actually started, the with effect from date.
Okay. And is this something you fill out every time?
Good question. Mostly no, it's largely a one-time entry. But you can edit most fields later if things change, like say your primary activity.
Mostly. So there are exceptions.
Yes, and this is really key. You cannot just go in and change the establishment's name or address once entered. Same goes for the verified PAN details and the actual section or paragraph of your exemption.
So if those do change, what then?
You need to submit a formal request to the PF office. It underlines how important it is to get that core information right the first time.
Okay. And you mentioned PAN verification.
Right. The system cross-checks the PAN you enter against the Income Tax Department's database. It'll show you if it's verified, helps keep everything consistent,
Makes sense. And those order or notification fields for the exemption?
Those depend on what you select for the exemption under Section Para. If you choose, say, Section 17(1)A or Para 27A, you get one set of fields related to relaxation orders. If you choose Para 27, you get fields for the actual exemption order it adapts.
Got it. And that with effect from date you mentioned earlier?
Crucial. That date directly determines the first month you have to start filing these online returns. So if your exemption kicked in from, say, July, your first return is for July.
Okay, clear. What about companies with multiple branches? Some might have their own codes, right?
Yes, good point. The rule is clear. Branches with subcodes or separate codes do not file their own returns.
So the main office handles it all.
Exactly. The main establishment includes all its branches in its single return. Doesn't matter if they fall into different RPFCs. The system even lets you see a list of these separately coded branches.
And branches without codes.
There's a section for listing those too. It's all centralized under the main establishment filing.
Okay, Module A covered. Let's move to Module B, trust details.
Yeah.
So this is about the entity managing the fund.
Precisely. This module focuses entirely on the trust itself.
What kind of details are needed here?
Again, the essentials. The trust's PAN and its full name, the complete address. Then details from the income tax order that recognizes the trust, the order number, date, who issued it,
Right.
and a very important selection. The type of trust. Is it a single trust, managing funds just for your establishment and its non-exempt branches? Or is it a CPF trust, a common PF trust, which manages funds for multiple independent participating units alongside yours? This choice has big downstream effects.
Okay, we'll come back to that. What else in Module B?
Details of the chairman and other trust representatives you need to specify if they represent the employer or employees and if they were elected or nominated. Also, information about the trust's DMAT and CSGL/SGL accounts. These are for holding securities electronically.
Right, your investments.
Exactly. And then the trust's bank account details. The system collects this, interestingly, to help with electronic fund transfers from EPFO or other trusts.
Just one account.
Yes, only one. And that info gets pre-filled later in online transfer claim forms, which is quite neat. Finally, you enter the date of the last constitution of the Board of Trustees.
And like Module A, is this mostly one-time entry? Can things be edited?
Yes, mostly one time, and editing is possible for many fields, but again, there are critical exceptions.
Let me guess. PAN.
You got it. The verified PAN details of the trust cannot be edited once saved. And, crucially, that selection between single trust and CPF trust, that's locked in too once you save it.
Why is that choice so fixed? You mentioned downstream effects?
Because it fundamentally changes how modules E and F work for you. If you're a single trust, you report everything. If you're part of a CPF trust,
As a participating unit.
right, if you're just a participating unit in a larger common PF trust, then modules E, investments, and F, annual info, become view only for you.
Because the main parent trust is responsible for filling those out.
Exactly. The parent trust of that CPF handles the investment reporting and annual details for everyone in that common fund. So getting that single versus CPF designation right up front is vital.
That makes perfect sense. Okay, so that's sorts A and B. Now, module C, D, and E, these are the monthly ones, right?
Yes, these require regular monthly updates. Let's start with Module C, Employee Details.
What's involved here month to month?
It's about tracking your workforce numbers. First, you enter the number of employees you had at the end of the previous month.
Is that manual every time?
Only the very first time you file. After that, the system automatically carries forward the closing balance from the previous month as the opening balance for the current month.
Okay, convenient again.
Then you enter the number of new employees who joined during the current month and the number who left. The system then calculates the total employees at the end of the current month for you.
Simple enough. What else?
You also need to specify the number of employees who are excluded from PF contributions for whatever reason.
Okay.
Entering that number lets the system calculate the net count of employees the establishment actually needs to comply for.
Right, the ones actively contributing or eligible.
Precisely. And then there's a detailed breakdown needed for contract employees. You have to specify if they're complying under your trust, or if they're unexempted and covered under a different PF code within your establishment, or if they're employed via a contractor who has their own separate PF code.
Okay, that's quite specific.
It is. You also report on your direct payroll employees, splitting them between those covered by your exemption under the trust and those who are unexempted, covered by the regular EPF scheme.
And any special categories?
Yes. Finally, you provide the total counts for any international workers and any disabled workers you employ. The system kind of expects you to double check that your direct and contract employee counts add up correctly to the total compliance number.
Got it. Lots of detail in C. Let's move to Module D, contribution details. This must be about the money.
Exactly. This is where you report the monthly PF contributions.
How does that start?
You begin with the opening balance of any PF contribution that was still due from the employer at start of the month. Again, this is a one-time entry in your very first return. Then, for the current month, you enter the total PF wages liable for contribution. Based on that, you input the employee's share and the employer's share of the contribution.
What about refunds or transfers?
You report those too. Any PF refunds that became due during the month, and any amounts transferred in or transferred out of the fund for employees moving jobs, for example.
And the total due?
The system calculates the total amount due for the month automatically based on those entries.
What if the contribution isn't paid all at once?
The module handles that. You can enter details of each partial transfer you make to the trust, the date, and the amount.
Okay.
The system then automatically adds these up to show the total amount transferred so far and calculates the remaining balance due for transfer.
And if a payment is late?
If there's a delay transferring the money to the trust bank account, you need to enter the amount of interest paid to the trust because of that delay.
Right, covering the lost earning potential for the members. Okay, that's D. Now, Module E, investment details. This sounds like a big one.
It is, and it's monthly. But remember the key point we discussed earlier.
This is only for parent trusts to fill out.
Exactly. Either establishments with their own single trust or the parent trust in a common CPF structure. If you're a participating unit in a CPF trust, this section is view only for you.
Okay, so assuming you are the parent trust, what's in Module E?
It's comprehensive. It covers everything about the trust investments. First section is securities.
Stocks, bonds, that sort of thing.
Yes. You start with an opening balance that's a one-time entry. Then, monthly, you report any securities that mature during the month and any new investments made.
What details for new investments?
Things like the deal value, any accrued interest paid at purchase. The system then auto-calculates the closing balance of your securities. It handles various categories and includes the newer investment patterns introduced after May 2015.
Okay, beyond securities.
There's a section for cash. Again, a one-time opening balance. Then monthly entries for cash movements in and out. The total cash balance is auto-calculated.
Right. Then receipts, money coming in.
Yes, a detailed receipt section. You record PF contributions received, any refunds from loans and advances members paid back, money transferred in, any other miscellaneous receipts.
What about employer contributions for losses?
That's there too. Recoupment by employer for capital or revenue loss. And, of course, returns from investments.
How are investment returns broken down?
Quite granularly. Interest is tracked previous due, current receivable, actually received, and the balance outstanding. Same for maturity amounts, previous due, current receivable, which gets auto-filled from that matured during the month section we mentioned. Then amount received and the balance, plus any other investment income received. The total receipts for the month, auto-calculated.
Okay, another side of the coin, payments.
Yep. You record claim payments, including transfers out, loans and advances given to members, and any other payments the trust made. Total payments, also auto-calculated.
Okay, so after all that in and out,
The system shows you the net result, the amount available for investment. It then shows the total amount actually invested by the Board of Trustees. This figure is auto-populated based on your detailed investment entries.
leaving.
The final cash balance. It even calculates the percentage of cash balance against the available amount. And if there's a significant chunk of cash left uninvested, you have to provide a reason why.
Wow, okay. That's detailed tracking. You mentioned detailed investment entries.
Yes, there are hyperlinks within Module E. Clicking on Securities, matured amount, or invested amount takes you to separate screens where you enter the specifics of each security, each maturity, each new investment transaction.
So it's not just summary figures,
No, definitely not. And there's one more critical part linked from Module E,
which is
claims and grievances details. This also needs monthly updates.
what kind of data goes here?
For claims, the opening balance of pending claims, how many new ones were received, the total workload, then how many were settled within 20 days, how many took longer.
Percentages too.
Yes, percentages for timely disposal, also the number still pending at month end, the percentage pending, and crucially, the reasons for those pending claims.
And grievances.
Similar setup, opening balance, received, net workload disposed of, percentage disposed, closing balance pending, percentage pending. It's all about accountability and transparency in member service.
Absolutely. Module E really underscores the heavy responsibility on parent trusts. Okay, that takes us through the monthly stuff. What about Module F, annual information?
Right, Module F is a once-a-year task. You can only access it after March 31st each year because it covers the whole previous financial year.
And again, only for parent trusts.
Correct. Exclusively for parent trusts.
What's the first part of this annual reporting?
Section I is audit of accounts. You state the financial year up to which the trust's accounts have been audited.
And details about the auditor.
Yes, for the last 6 years actually.
Yeah.
Name, address, their CA registration number. Then you have to say whether the latest audit report was sent to the regional PF commissioner, RPFC.
What if it was?
You provide the year, the cover letter number and date, and the date the RPFC received it.
And if it wasn't, or if it's the first filing of the year?
There's a specific instruction. For the first filing in a financial year, select No for sent to RPFC, and then you actually upload the scanned audit report directly through the portal.
Ah, okay. So the upload happens during that first annual filing. What's next in Module F?
Section 2. Details of the annual statement of account for members. You enter the date up to which the statement was issued.
Any member balances?
Yes. Number of contributing members and their total closing balance. Number of non-contributing members and their total closing balance.
What about interest?
You report the total amount available for distributing interest, the actual rate of interest declared and credited, and whether the employer had made good any shortfall in interest.
Other operational details?
Yes, things like, is interest calculated monthly? Are accounts kept electronically? Can members view their balance online? Are the fund rules displayed for members? It checks on transparency and member access.
Makes sense. What's Section 3?
Financial health of the holdings. Pretty straightforward. The total holding value of the trust at financial year end, and the total market value of those holdings then.
Okay. Section 4.
Amortization account. You report the opening balance, any additions or reductions during the year, remembering to enter reductions as negative numbers, and the closing balance.
Got it. And the last parts, you mentioned defaults earlier.
Yes, sections V and C deal with defaults. Section V is maturity in defaults. For every security that defaulted on its principal repayment.
You list them individually.
Yes, you identify the security, provide its ISIN, its face value, the deal value and purchase, the amount receivable, how much was actually received, and the system calculates the amount in default, receivable minus received.
And Section 6.
Interest and defaults. Same idea, but for missed interest payments. Identify the security, ISIN, interest receivable, interest received, and the calculated interest in default. It ensures any investment issues are clearly reported.
That covers all 6 modules then. A very structured process. Are there any other general system features we should mention?
Definitely a few key ones to recap. Access, as we said, is via the establishment login on the unified portal, specifically for exempted entities.
Right.
And remember, the RPFC can block future filing if your exemption gets canceled, though you can still file for past periods when you were exempt.
And the branch filing point is worth repeating.
Absolutely. Subcodes or separate codes for branches don't mean separate returns. The main establishment files one consolidated return covering everyone.
Useful for records, you mentioned a PDF.
Yes, after you complete the monthly parts, C, D, E, there's a consolidate PDF option. Good for saving or printing a record of that month's submission.
Okay, and what if you make a mistake? It sounds complex, errors must happen.
They can. That's where the delete part functionality comes in. It's usually within your establishment login.
How does it work?
If you spot an error in part C, D, E, or even F after submitting, you select the part, like Module D, and the specific month and year you need to correct.
Then what?
The system generates a request letter. You have to download it, print it, get it signed, scan the signed letter, and upload it back. Then you submit the request for a data reset.
And once approved?
The incorrect data for that specific part and period is wiped, allowing you to re-enter the correct information.
So you can't just call a help desk to fix it?
No, absolutely not. The help desk can't edit your data directly. The establishment must initiate corrections through their own secure login using this process. It maintains accountability.
Right. So bringing this all together then, we've really gone deep into this online return filing process for EPF exempted establishments.
We have. It's clearly very structured, modular, with different reporting rhythms monthly and annually.
And we've really tried to highlight those key differences in responsibility, especially between the parent trusts who handle investments in annual reports and the participating units who mainly view that data.
Yeah, that distinction is fundamental, and hopefully outlining the correction process using the delete part function is helpful too.
Definitely. I think while this deep dive, this audio guide gives a really solid overview, people still need to be careful when they're actually in the portal, right? Following the specific on-screen instructions and checking their data.
Absolutely. This provides the map, the foundation, but the actual journey requires careful navigation within the system itself. Hopefully this makes that navigation feel less daunting, more effective.
Agreed. So as we wrap up, maybe a final thought for our listeners to mull over.
Okay.
Considering the sheer level of detail, the complexity we've just walked through in this online return system,
Yeah.
what does that really tell us about the level of oversight and I suppose the accountability that's expected from these exempted establishments when they're managing their employees' provident funds?
That's a really potent question to reflect on. It definitely signals a high bar for governance and transparency.
We often look at our payslip, right? See the deductions for PF, but maybe don't think too much about what happens next.
Exactly. There's a whole system behind the scenes, especially for what are called EPF exempted trusts.
Right. These are companies managing their own employee provident funds, but under strict rules. Today, we're diving deep into how these trusts are audited here in India.
It's about understanding how that safety net, your retirement savings, is actually monitored, how the guardians are watched, so to speak.
And this isn't just some theoretical exercise. Knowing this helps understand how your financial security is being regulated. It all links back to the Employees Provident Funds Act of 1952.
And the EPF scheme from the same year. These are the foundations.
We've waded through the detailed guidelines, the official circulars, the audit framework itself. Quite dense stuff.
Definitely. Our aim here is to kind of unpack it all for you, make it clear, accessible. We want to act as a replacement for those documents, making sure all the crucial information is easy to grasp.
Consider this your shortcut to understanding a really vital part of the system. So let's start with the basics. This audit report, what's its main purpose? Who's it for?
Okay, so this specific report we're looking at comes after a re-audit. It's triggered under a particular rule, Condition 24A of Appendix A, Para 27AA of the EPF scheme.
Okay, bit of jargon there, but essentially a specific rule kicks off this detailed second look.
Precisely. And its core job really is to check if the trust's financial statements, the income and expenditure account, the balance sheet are accurate, and also this thing called Form RM6.
Ah, yes, Form RM6. That sounds important. What exactly is that?
It's basically a standardized report. Think of it like a fact sheet for the exempted trust, covering key operational details. The auditor's job is crucial here. They have to verify everything on this form.
Verify it how?
They check it against the trust records and then certify if it's accurate, flagging any issues or observations they found during the audit. It ensures all that vital information is properly checked and reported.
And who receives this report? The employees, the company.
Primarily, it goes to the Regional Provident Fund Commissioner, the RPFC.
The regulator.
Exactly. It's their tool to make sure the trust is playing by the rules, managing the funds correctly. It's about accountability, really, making sure everything's transparent.
Got it. So the RPFC is the main audience, using it for oversight. Now, this re-audit, what exactly are the auditors digging into? It sounds pretty thorough. We need to know what crucial information they hunt for.
Oh, it is. Very comprehensive. They look at, well, almost everything. Financials, naturally, but also details about the company itself, the trust structure, how it's run.
Okay, let's break that down. Give us some examples. What are some of the maybe surprising or key things they check?
Sure. Let's start with establishing details. It's not just the main company. They need Annexure A, a full list of every unit, every branch involved, even if it doesn't have its own PF code.
So no hiding parts of the business.
Right. And then Annexure B confirms that each of those units actually has the required EPF exemption. Consistency is key. Every part needs to be officially covered. That's crucial info.
Makes sense. What about the trust details, the trust itself?
Okay, here they check fundamental things like the income tax order that legally recognizes the trust. That's foundational.
Right.
And, very importantly, the board of trustees. Who's on it? Does the mix of employer and employee representatives meet the requirements? That's Para 79C of the scheme. And Annexure D gets into the specifics. The governance structure has to comply.
So they check the legal basis and the leadership structure. What about the trust rules? Can trusts just make up their own rules?
Not entirely. Condition 10 is important here. It says any changes to the main EPS scheme that are better for employees must be adopted by the trust.
Automatically?
Yes, even if they haven't formally amended their own rulebook yet. The benefit applies from the date the main scheme changed. That's a crucial protection.
That's good to know. What if the employer wants to change rules for other reasons?
That falls under Condition 11. Any other rule changes need prior approval from the RPFC. So the regulator gets a say before anything changes that isn't a direct beneficial EPF update. Another layer of oversight.
Okay. Now, thinking about the employees, what's checked regarding employee enrollment? This seems critical.
Absolutely vital. The auditor has to verify, using Annexure F, that all eligible employees are members. And all explicitly includes contractual employees as defined in the Act.
So no one slips through the cracks.
They check meticulously against payroll and other records. So for you, the employee, this check ensures everyone entitled to PF benefits in your company is actually enrolled. That universal coverage is crucial information.
That's reassuring. How about the money itself? Remittances and returns, tracking the contributions.
Yes, they track it month by month. Annexure J details what the employer owes the trust, when it was paid, and calculates interest or penalties for any delays. Sections 7Q and 14B deal with that.
So penalties for late payments.
Definitely. They also look for any missed contributions or amounts posted incorrectly. It's about ensuring the money flows correctly and on time. All crucial financial information.
Following the money. Okay, once the money is in the trust, where does it go? Investments must be a huge focus.
A massive focus. Trusts have to follow very specific government investment patterns. And speed matters. They check if funds are invested within 2 weeks of receipt.
2 weeks, that's fast.
It is. Annexure Q tracks this. If there are delays or if surplus funds aren't invested properly, there can be surcharges. The idea is to get the money working for the employees quickly.
And where can they invest? Are there strict limits?
Very strict. To minimize risk. For instance, most debt instruments need a minimum AA credit rating. Commercial paper needs A1+.
High quality stuff.
Exactly. Annexures Q and S document any deviations from these approved patterns and the potential consequences. Think of it as ensuring your retirement savings aren't exposed to undue risk. That rating check is crucial information.
Good. Safety first. What about when employees need their money? Claims settlements.
Huge emphasis on timely payments here.
Yeah.
Annexure N requires details where claims settled within the time limits set by EPFO.
And loans or advances.
Also checked. Annexure O verifies if they were granted based on the rules, either the EPF scheme rules or the trust's rules, whichever is more beneficial for the employee. It ensures fairness and efficiency when you need access.
Makes sense. And the return on those investments, the rate of interest, how's that audited?
They compare the interest rate the trust declares with the rate set by the central government.
What if the trust didn't earn enough to match the government rate?
That's where Annexure P comes in. The trust has to explain how it will fund the difference. They can't just shortchange employees. They also check that interest is calculated monthly on the balance. Ensuring that rate alignment is crucial.
So employees are protected from arbitrary low rates. What happens if things go wrong? Losses in expenditure.
Several safeguards here. Selling securities usually needs prior RPFC approval. That's condition 20. All admin costs. Borne by the employer, not taken from contributions.
That's big.
It is. And critically, if the trust incurs investment losses, the employer generally has to make good on that loss. It protects the employee's capital. A very crucial piece of information for security.
That really incentivizes careful management by the employer. Any other specific groups or situations looked at?
Yes, if there are international workers, Annexure W covers specific reporting for them. And forfeiture and unclaimed amounts are tracked too.
What happens to unclaimed money?
It's monitored. Annexure X has details and eventually, under the rules, transferred to the Senior Citizen Welfare Fund. Annexure Y tracks that transfer. So it's accounted for and goes to a designated place.
Okay, that covers a lot. You also mentioned surrender or cancellation of exemption. What happens then?
If a trust stops being exempt, voluntarily or not, there are extra checks. Did they give 30 days notice? Has the employer covered all losses?
And the employee's money.
Crucially, they verify the transfer of all past savings cash and investments to the main EPFO fund. Annexures A1 and B1 detail this. There's also a need for an independent financial health certificate, Annexure C1. It ensures a clean, protected transition.
Wow, okay. That is incredibly detailed. It really feels like they try to cover every angle to ensure crucial information isn't missed.
Let's circle back to that Form RM6. Why is it so significant in all this?
It's significant because it standardizes the reporting. It pulls together key information company details, contributions, investments, claims data into one consistent format.
A snapshot.
Sort of, but a verified one. The auditor certifying it means the RPFC gets a reliable overview of the trust's compliance and operational status. It covers so many crucial data points, making it a cornerstone of the oversight process.
And the auditors themselves, what's their main role boiled down? What are their core responsibilities?
Their core job is independent verification. Conduct a thorough audit, check everything meticulously, verify that Form RM6, report any issues or observations clearly.
And give an opinion. Yes, provide their professional opinion on the financials in the form. Plus, those specific checks we mentioned, board composition, investments, claims timelines, and in a surrender scenario, certifying financial health. Their independence is key to making sure all the crucial information reported is reliable.
It really underscores the value of that independent check. So bringing it back to the employees, how does this whole framework ultimately protect their interests? Summarize that connection for us.
It protects them in multiple ways. Mandatory membership for everyone eligible, timely contributions ensured, getting the benefit of any positive EPF scheme updates, fair and timely claim processing, interest rate compliance, prudent investment management.
And the employer covering costs and losses.
Exactly. Employer bears admin costs and makes good on losses. It's a multi-layered safety net built into the audit process, checking all those crucial aspects for employee financial well-being.
The investment part seemed especially rigorous. What are the absolute non-negotiables for trusts managing investments, the critical compliance points?
Adherence to the notified investment pattern is number one. Investing within that 2-week window. Using only approved securities meeting those minimum credit ratings like AA or A1 plus King.
No risky bets.
Generally, no unrated bonds or similar high-risk stuff. Transactions must be fair, at arm's length, securities held safely with depository participants, timely collection of investment income, and again, employer compensation for losses. Providing full, accurate information on all this is non-negotiable.
Okay, and if a trust does surrender its exemption, what are the absolute critical checks during that wind-down phase? The crucial information needed.
The critical focus is protecting employee funds during the handover. So, verifying the surrender proposal is correct, ensuring the employer has covered all outstanding losses, and meticulously checking the complete and timely transfer of all past accumulations, cash, and investments to the EPFO.
Making sure every rupee is accounted for.
Precisely. Plus, confirming UANs are verified, all other dues paid, reserves transferred, and getting that crucial independent financial health certificate. It's about ensuring a clean break and no loss to employees.
Finally, you mentioned lots of annexures. What's their overall role? Why so many detailed attachments?
The annexures are the proof. They provide the detailed backup for everything stated in the main audit report. They contain the raw data, the specifics,
Right.
like the list of branches, the month-by-month contribution figures, the exact securities held, the claim settlement timelines, details on international workers, unclaimed balances, everything.
So they add transparency.
Exactly. Transparency and accountability. They allow the RPFC to drill down into any specific area if needed. They turn the report from a summary into a detailed, verifiable record, ensuring all that crucial information is captured and available.
So wrapping this up for our listeners, this deep dive shows there's a really robust system overseeing these EPF exempted trusts. It's much more than just ticking boxes.
It really is. It's about financial discipline, protecting employee welfare, and ensuring these significant retirement funds are managed responsibly. Lots of checks, lots of balances.
All aimed at making sure that crucial information is tracked, verified, and acted upon to safeguard your future savings.
Which leaves us with a thought, perhaps. Considering this level of detailed scrutiny, this focus on capturing all crucial information, what does it signal about how seriously employee retirement security is taken within India's financial framework?
Definitely something to reflect on. The sheer complexity and oversight suggest it's a high priority.
It certainly seems designed that way, to provide assurance and accountability.
Well, if this has piqued your interest, there's always more to learn about employee benefits and financial regulations. But for now, that concludes our deep dive. Thanks for joining us. Welcome to the deep dive. You know how it is you're trying to get your head around something important, maybe a bit complex, and you're just faced with this stack of documents.
Yeah.
You sent us a bunch on the EPFO Citizens Charter, and, well, let's be real, wading through all that takes time most of us don't have.
Exactly.
So our mission today really is to boil it all down. We want to pull out the absolutely crucial bits, give you the insights you need, sharp and clear. Think of this as your shortcut to understanding what the EPFO is actually promising and, what that really means for you.
Absolutely. And you gave us some good stuff to work with. The charter document itself, there was a study guide too with quizzes and terms.
Right.
A briefing paper that kind of summarized it, and even a quick reference guide with FAQs. So yeah, we've really dug into all of it to pull out what matters most.
Perfect.
By the end of this, hopefully, you'll have a really solid handle on EPFO's service promises, what they expect from us, the stakeholders, and how to, navigate the whole system.
Okay, let's dive in then. Starting big picture, what's the main ambition here? What's the EPFO actually aiming for with this Citizens Charter?
Well, their stated vision, it's quite ambitious actually. They're aiming to be an innovation-driven Social Security organization.
Okay.
The goal is universal coverage, basically getting everyone included, and ensuring, this is a keyword they use, NIRBOD service delivery.
NIRBOD, what does that mean exactly?
So NIRBOD means seamless and uninterrupted. The idea is, accessing your funds, your pension, whatever it is, without any snags or delays. That's the end goal.
Seamless and uninterrupted, sounds good.
And they plan to get there using state-of-the-art technology. That's a big part of it.
Right, technology. So NIRBOD, seamless, uninterrupted. How are they planning to actually make that happen? What's the core mission?
Okay, so the mission breaks down into a few key areas. First, they want to adapt to our changing Social Security needs and do it transparently so you can see what's going on. Contactlessly, facelessly, meaning less need for physical visits or face-to-face stuff, and paperlessly, cutting down the paperwork.
Less bureaucracy, always welcome.
Definitely. And crucially, they're committed to delivering these NIRBOD services, even if there are disruptions.
Okay.
They talk about things like having systems in multiple locations, auto claim settlements, basically ways to disaster-proof the EPFO.
Disaster-proofing, that actually sounds really important, especially these
You
days.
provide some peace of mind, right? And the mission also focuses on improving ease of living for members and pensioners.
Making life easier.
Exactly. And also ease of doing business for employers. Streamlining things for them too. They plan to use the government's big digital platforms like DigiLocker and UMANG to make all these processes smoother and reach more people.
All right, that gives a good sense of the overall direction. Now, let's get down to the specifics that, really impact people day to day. What about service standards, especially for employees?
All right, this is where it gets really interesting for employees. The charter lays out specific time frames for settling claims. And here's the thing. These standards are aspirational. They're actually faster than the legal limits in the old EPF and MP Act from 1952.
Faster than the law technically requires. That sounds like a big deal.
It is. They're setting a higher bar for themselves.
Okay, give me some examples. How does this actually play out?
Sure. Let's take PF final withdrawal. This is Form 19. The old scheme time was up to 20 days.
Okay.
The new target in the charter, just 7 working days.
Wow, 7 days. That's nearly 3 times faster.
Exactly. Think about getting those funds so much quicker. Or look at advances for illness or the special pandemic advance. Both use Form 31. Those used to be 20 days too.
Right.
The target is just 3 working days.
3. That can make a massive difference in an emergency.
Huge difference. And it's the same 3-day target when nominees or survivors need to withdraw PF using Form 20 or for the insurance payment using Form 5IF. Both were 20 days before.
Yeah.
Even more routine things, like a partial withdrawal or transferring your PF when you switch jobs, Form 31 and Form 13, respectively. They've also gone from 20 days down to a 7 working day target.
Those are some really significant improvements across the board. Knowing you could potentially get funds that quickly, especially when you really need them, must be a relief for a lot of people.
Absolutely.
What about pensioners? Are they seeing similar speed-ups?
Yes, they are. For pensioners starting their monthly pension, that's Form 10D, the processing time is also down from 20 working days to just 7.
Okay, same 7-day target.
And it's the same if you're withdrawing your benefit or getting a scheme certificate using Form 10C. That's also down to 7 working days from 20. So yeah, faster service commitments apply post-retirement too.
Good to know it covers both phases. Now, what about international workers, people working in India from other countries? Any specific standards there?
Yes, there's one specifically mentioned for them. For issuing a certificate of coverage, which is quite important for international workers under Social Security agreements, the standard is set at 3 working days.
Okay, 3 days for that. And you mentioned disaster proofing earlier. Does the charter say these faster times will hold up even if, say, there's some major disruption?
Yes, it explicitly states that. The EPFO commits to maintaining these service standards even during, unforeseen events. That disaster-proof idea means they've supposedly built in resilience to ensure service continuity.
Right, so the aim is reliability even when things get tough.
That's the goal.
Okay, so the EPFO is promising faster, more reliable service. But surely this isn't just a one-way street. What do they expect from us, these stakeholders, employees, pensioners, employers, to make this all work?
That's a really critical piece of the puzzle. It definitely requires participation. For new members just starting out, there are a few key things.
Like what?
Creating your UAN-based login, that universal account number, is your anchor. Linking your KYC details, especially Aadhaar. Providing details of any previous PSAF counts so they can get auto-transferred that avoids hassle later. Filing your e-nomination online, which is super important. And providing your bank and PAN details electronically too. Basically getting that digital foundation set up correctly right from the start.
Makes sense. Get the basics sorted online early on, and it should smooth things out later. What about those of us already in the system, existing members?
For existing members, the EPFO encourages using the online resources. They point specifically to the FAQs on their website. You can mention the links, actually.
Oh, yeah.
It's epthindia.gov.insightingfaq.php, and there's a specific one for COVID questions, too. tepsindio.gov.insighttakingcovid19.php.
Okay, good to have those.
They also want members to understand their benefits better, maybe using the online calculators for pension or the EDLI insurance scheme.
Right.
And importantly, if a member passes away, they expect the nominee or legal heir to contact EPFO promptly to get the claims process moving.
Okay. And for pensioners, what are their key responsibilities for keeping things running smoothly?
For pensioners, the big one is the annual Jeevan Praman and Patra the Life Certificate.
Ah, yes, the proof of life.
Exactly. They need to submit that every year. The charter lists lots of ways to do it now, which is helpful. You can use the Jeevan Praman portal itself. That's jeevanpraman.gov.in.
Okay.
Or go to banks dispersing the pension, EPFO offices, those common service centers or CSEs, India Post Payments Bank.
Lots of options.
Yeah, even potentially a postman or banking correspondent coming to your home. Plus, there's the UMANG app, and they mentioned UIDI, face authentication technology as well.
Face authentication, okay, that's quite modern.
It is. Beyond the life certificate, pensioners should also inform EPFO if they change bank branches. Use DigiLocker for their documents if possible. Use the UMANG app for their pension passbook. And crucially, ensure EPFO is informed quickly if the pensioner passes away. This helps process any survivor benefits smoothly.
Right. And what about employers? They have a role too, obviously.
A big one. For employers, it starts with basic compliance, following the rules, enrolling eligible employees on time, filing their monthly returns and payments electronically, making sure new employees get their UAN generated or linked, and updating joining and leaving dates promptly.
So keeping the data accurate.
Exactly. Also, helping employees with their KYC and UAN logins, quickly handling any error correction requests, responding to EPFO notices, attending webinars EPFO organizes,
Okay.
resolving employee grievances related to PF within 5 working days themselves if they can, and for exempted establishments, ensuring they provide benefits that are at least comparable to or better than the statutory schemes.
Got it. So everyone has a part to play. Now, things don't always go perfectly. What happens if someone does have a problem, a complaint, or a grievance? What's the mechanism?
They have a dedicated system called EPF-IGMS. That's the EPFO Grievance Management System.
EPF-IGMS.
It's an online portal, www.epfigmbest.gov.in. You can also access it through the UMang app. That's the main channel. They also hold regular webinars, partly to address common issues and raise awareness. The general target for resolving a grievance is 7 working days.
And if it's not resolved in 7 days,
It's designed to automatically escalate to a higher authority within EPFO for review.
is there like a specific person or office to contact if the online system isn't enough, or for a more serious issue?
Yes. The designated public grievance officer at the head office is the additional central PF commissioner dealing with the Customer Services Division, CSD. Their address is in Delhi. Bhavisha Nidhi Bhawan, 14 Bakaiji Kama Place, New Delhi, 110066.
Okay.
But besides the EPF-GMS portal, there are other channels too. You can use the main government CPG Grams portal, www.pgportal.gov.in. There's a 24/7 toll-free call center, 1-800-118-0005. They also list specific WhatsApp helpline numbers for different regional offices on the main EPFO website.
App even? Okay.
Yeah, and social media too. They have official handles on Twitter and Facebook at SocialEPFO or SocialEPFO. So multiple avenues to raise an issue.
That sounds pretty comprehensive, actually. Lots of ways to get help. Finally, just to give us a sense of scale, how widespread is the EPFO's physical presence?
They have a really extensive network across India. It's structured with 21 zonal offices,
Okay.
which oversee 138 regional offices. These regional offices handle a lot of the core work: employer compliance, service delivery, supervising the district level.
Right.
And then below them are 117 district offices, which focus more locally on compliance and grievance handling.
So quite a footprint.
A very significant one, yeah. It's designed to ensure they can reach people and deliver services effectively nationwide. And all the contact details for these offices are on their website at findia.gov.in under Contact Us.
Good to know. Now, we've thrown around quite a few acronyms and specific terms. Maybe we could quickly run through some key definitions just to make sure everyone's on the same page.
Good idea. Let's clarify some of those.
Okay, first up, UAN.
UAN is the Universal Account Number. Your unique ID as an EPFO member stays with you, even if you change jobs. Makes PF transfers much easier.
Got it, KYC.
KYC is Know Your Customer. Basically verifying your identity and address. Essential for pretty much all financial services, including EPFO. It's about proving who you are.
Right. And Nearbod, we talked about that.
Nearbod, yeah. That Hindi word signifying their goal of seamless and uninterrupted service delivery.
Okay, PF.
PF is Provident Fund, the main savings scheme where you and your employer contribute, building up that retirement fund you can access later or for specific needs.
EPS.
EPS is the employee's pension scheme. A portion of the employer's PF contribution goes here to provide a monthly pension after retirement if you meet the service criteria.
EDLI.
EDLI stands for Employees Deposit Linked Insurance Scheme. This provides a life insurance payout to your nominee if you pass away while still working and contributing. The amount depends on your salary and PF balance.
Okay. Jivan Pramanam Paitra, or JPP.
Jivan Pramanam Paitra, JPP, that's the annual life. Certificate pensioners need to submit to prove they're still alive and eligible for their pension. UMang, the Unified Mobile Application for New Age Governance. It's that government super app where you can access services from many departments, including EPFO.
Right. EPF-IGMS.
EPF-GMS is the EPFO Grievance Management System, their dedicated online portal for logging and tracking complaints.
And finally, stakeholders.
Stakeholders is just the broad term EPFO uses for everyone involved, primarily employees, employers, and pensioners, all the key players in the system.
Perfect. That clears things up nicely. So if we were to wrap this all up, what's the single most important takeaway from this deep dive into the EPFO Citizens Charter? What does it all boil down to?
I think the main message is that this charter represents a really clear commitment from EPFO towards becoming much more efficient, much more technology-driven in how they deliver Social Security.
Right.
They've set these clear, quite ambitious service standards faster than before, and they've also laid out what they need from all of us, the stakeholders, to make it work effectively. It's basically their public promise for a better, faster, more accessible system for everyone.
That makes sense. It's a statement of intent. Now, thinking about those ambitious goals and the fact that it relies on both EPFO systems and our participation, what do you see as maybe the biggest potential challenges in actually making all this happen? And conversely, if they do succeed, what could the real impact be for individuals and businesses?
That's a really good question to ponder. I mean, one potential hurdle could be digital literacy and access, right?
Yeah.
Especially ensuring all stakeholders, maybe older pensioners, can comfortably use the online tools and meet those digital expectations.
The digital divide.
Exactly. And just maintaining the massive, reliable tech infrastructure needed across the whole country is a constant challenge in itself. But if they can overcome these hurdles, if they really achieve the aims of this charter, the impact could be pretty significant.
How so?
For individuals, it means quicker access to essential funds, whether it's for illness, retirement, or other needs, less waiting, less uncertainty, potentially less stress during crucial life moments. For businesses, particularly smaller ones, smoother processes for compliance could free up administrative time and resources. It contributes to that ease of doing business's idea. So ultimately, successfully implementing this charter has the potential to really strengthen India's Social Security framework in a tangible way.
Some really important points to think about there, both the potential benefits and the challenges ahead. Well, thank you for walking us through all of that today. It's been really insightful.
My pleasure. It's an important topic.
And to you, our listener, we really hope this deep dive has given you that clear, comprehensive understanding of the EPFO Citizens Charter that you were looking for your effective replacement for wading through those documents. Thanks for joining us, and until our next exploration on the deep dive.
Okay, so we've got these detailed documents about EPF exemption conditions. Quite a bit to wade through.
Definitely. They're pretty dense.
Yeah, exactly. So I think today, our mission really is to pull out the absolute essentials. What are the core responsibilities, and what does it actually mean for employees without getting tangled up in all the jargon?
Sounds like a plan. We were talking about when employers get to manage their own provident funds, right? Instead of the standard EPF scheme.
That's the one. And we're drawing from, let's see, 09 exemption conditions.pdf, the concise review, the employer and trustee obligations, and the study guide. So a good mix of sources.
A comprehensive set, yeah. Should give us a solid picture.
Right. So we want to understand the rules for these exempted places. What do employers have to do? And maybe more importantly for listeners who might be in one, what are the protections? What safeguards are built in?
Good place to start is, well, how does an employer even get this exemption? What's the first step?
From what I read, it seems like the absolute foundation is setting up a board of trustees.
Exactly. That's requirement number one. Establish a board of trustees.
And it's not just a board, the employer actually chairs it, don't they?
They do. The employer takes the chairmanship. This board then becomes sort of the command center for the fund.
Okay.
Their main job is managing it, obviously, but they're also accountable to the EPFO.
The main Provident Fund organization.
Yeah, accountable for all the money contributions coming in, payments going out, the balance, keeping meticulous records.
And because the employer is the chair, they carry a lot of personal responsibility for that, I imagine.
A huge amount. If things go wrong with the fund management, it reflects directly on them.
Now, I noticed something. The definition of employer. It seems slightly different for factories compared to other places.
Yes, that's a nuance. For a factory, it's typically the owner or the occupier. Pretty straightforward.
Okay.
But for other types of establishments, it's defined as the person or the entity, the one with the ultimate control over how the place is run.
Right. So it adapts a bit depending on the business structure. Makes sense.
Exactly. It has to cover different organizational models.
So this board is set up, employers in charge. Do they just meet whenever? Or is there a schedule?
Oh no, it's regulated. They absolutely have to meet at least once every 3 months.
Okay, quarterly meetings, minimum.
That minimum ensures they're keeping tabs on things regularly. And they don't operate in a vacuum either. They have to follow guidelines.
Guidelines from who?
From the central government or the CPFC, the Central Provident Fund Commissioner, or, someone authorized by them. There's external oversight.
Right, so there are checks and balances from the top. Okay, board set up, meeting, following rules. What about this is all for the employees. Who gets included in this company-run fund?
This is super important for anyone listening who works at one of these places. The rule is crystal clear. Every single employee who would have been eligible for the normal EPF scheme must be enrolled in the exempted fund.
So no cherry picking. If you're eligible, you're in.
No cherry picking, you're in. It ensures everyone gets that basic Provident Fund coverage.
That seems fair. What if someone starts a job there and they already have an EPF account from their last job?
Yeah, common scenario. The conditions cover that too. The employer has to enroll them immediately in the exempted fund. That's step 1.
Okay.
But step 2 is just as important. The employer is also responsible for getting the employee's money, their past accumulations, transferred over from their old EPF account or previous exempted fund into the new one.
So the burden is on the new employer to sort out that transfer.
Yes, they need to facilitate that whole process, make it smooth for the employee.
Got it. Let's talk money then. The contributions. How does that flow work? When does the money get moved?
There's a strict deadline. The employer has to transfer their share and the employee deductions over to the Board of Trustees pretty quickly.
How quickly?
By the 15th of the month after the contributions were due. So for January's contributions, the transfer has to happen by February 15th.
Okay, the 15th. Crystal clear. But, things happen. What if they miss that deadline? Are there penalties?
Oh yes. The law, specifically Section 7Q of the Act, kicks in. If the employer delays sending that money to the trustees, they have to pay simple interest on the amount they're late with.
So a financial penalty to encourage prompt payment.
Exactly. Keeps the money flowing into the fund on time.
Now, running a fund like this must cost something, right? Admin fees, record keeping. Who pays for all that?
That's another key point. The employer foots the entire bill for administration.
The entire bill. It doesn't come out of the fund or employee contributions.
Nope. All administrative expenses are the employer's responsibility. Full stop.
Wow. Okay.
And it goes further. If the fund loses money because of, say, theft or fraud or misappropriation, any kind of financial irregularity,
Yes.
the employer has to make that loss good. They have to cover it. They're essentially the backstop if something goes wrong financially.
So they're not just managing it, they're guaranteeing it against certain losses.
Yeah.
That's significant.
It really is. It's a major financial commitment and responsibility.
What about the interest employees earn? How does that compare to the standard EPF?
Good question. The Board of Trustees declares the interest rate for the exempted fund. However,
There's a catch.
not a catch, more like a safety net. If the rate the board declares is lower than the minimum rate set by the government for the main EPF scheme that year,
Then,
then the employer has to step in and make up the difference. They have to ensure the interest paid is at least as good as the statutory minimum.
okay. So employees are guaranteed not to lose out on the interest rate compared to the standard scheme. That's a crucial protection.
Absolutely. It ensures parity in that core benefit.
Let's shift to transparency. How do employees know what the rules are and how the fund is doing?
Transparency is baked into the conditions. The employer is required to display the approved fund rules prominently.
Where? Like on a notice board?
Yes, on the notice board. And any changes, any amendments have to be displayed too. Importantly, if needed, they have to provide a translation in the language most employees understand.
That's good. Clear communication. What about the benefits themselves? Can an exempted fund decide, oh, we'll contribute a bit less, or our withdrawal rules are tougher?
Absolutely not. That's a definite no-go area. The contribution rates, the rules for taking advances, the interest paid, none of it can be less favorable than the standard EPF scheme.
So it has to be at least as good, maybe better, but never worse.
Precisely. And get this, if the main EPF scheme gets an upgrade, like better benefits are introduced, those improvements automatically apply to the exempted fund too, even before the trustees formally amend their own rules.
Oh, wow. So improvements flow down automatically. That's a strong safeguard.
It really is, keeps things aligned.
What if the employer wants to change the rules of their own exempted fund? Maybe something not covered by the main scheme. Can they just do it?
No, they need permission first. Any changes to the exempted funds rules need prior approval from the RPFC.
The Regional Provident Fund Commissioner.
That's the one. And before the RPFC gives the green light, they have to give the employees a chance to share their views on the proposed change.
So employee consultation is built in.
Yes. It ensures their voice is heard before rules affecting them are altered.
Okay, switching gears slightly. When an employee actually needs their money, maybe a withdrawal, an advance, or transferring out, are there rules about how quickly the exempted fund has to process that?
Yes, efficiency is mandated there too. They have to settle all those claims, withdrawals, advances, transfers promptly. Meaning within the maximum time limit set by the EPFO itself. So even though it's an in-house fund, they're held to the same service standards as the main scheme for payouts.
Good to know. Keeps things moving. How about tracking everything? All the contributions, interest for each person? What are the record-keeping requirements?
The Board of Trustees has a big job here. They need to keep detailed accounts for every single employee, showing contributions, withdrawals, interest earned.
Paper ledgers.
Preferably electronic. That's the direction things are pushed, digital records for better accuracy and access.
Yeah.
And they have to be ready to send this data electronically to the authorities, the CPFC or RPFC, whenever asked.
Digital is definitely the way.
Yeah.
How do employees find out their own balance?
Two main ways. First, the board has to give every employee an annual statement of account or a passbook for free.
Okay, once a year update.
Within 6 months of the financial year ending, they can charge a small fee for extra copies if someone needs them. But also,
Yes.
employers also have to set things up so employees can check their balance electronically anytime, usually via a computer terminal.
Yeah.
Real-time access.
That's very useful. Instant checkups.
Yeah, transparency is key, right?
Definitely. What about overall reporting? Do these funds have to file reports with the EPFO?
Oh yes, big time. Both the Board of Trustees and the employer are jointly responsible for filing regular returns.
What kind of returns?
Monthly and annual ones, as prescribed by the EPFO, and they have to be filed electronically and on time.
What if they're late?
It's considered a default. Penalties can be imposed by the EPFO on both the board and the employer, so there are teeth in those reporting requirements.
Okay, serious consequences for missing deadlines. Let's talk about growing the money now. Investments. Does the board just invest wherever they think is best?
Not at all. This is very tightly controlled. They must invest the fund's money strictly according to investment patterns and directions issued by the government.
So they don't have free rein. They follow a government playbook.
Exactly. It limits risk and ensures the investment strategy is broadly similar to the main EPF, focused on safety and steady returns.
What if they ignore those government directions? Go off-piste with investments.
That's a serious breach. The trustees can be held personally liable individually and collectively for a surcharge.
A financial penalty on the trustees themselves.
Yes, imposed by the CPFC or their representative. It underscores how critical it is to follow those investment rules.
Right. And how are these investments actually held? Physically.
Mostly electronically now. The rules push for securities to be held in the trust's name, but in dematerialized form, DEMIT.
Digital certificates, basically.
Basically, it's more secure, easier to manage. If DEMIT isn't available for some reason, they have to tell the RPFC, but electronic is the standard.
And where are these DMAT accounts kept?
They have to use depository participants approved by the Reserve Bank of India and the central government, following official guidelines.
Okay, regulated institutions.
Yes. And the costs for this, like DMAT charges or brokerage fees, are paid by the trust as part of the investment process.
What about the custody? Where are these electronic securities actually kept safe?
They're held in safe custody with those same approved depository participants. They act as the guardians of the assets.
And if the company closes down or loses its exemption, what happens to those investments?
There's a clear process. The depository participant, the custodian, is obligated to transfer those investments directly to the relevant RPFC if requested, so the assets can be moved back under the EPFO's control smoothly.
That's a clear contingency plan. What if the investments themselves earn extra income, like a commission or a bonus? Does the trust keep that?
No, any extra income like that, commissions, bonuses, incentives from financial institutions must be credited straight back into the Provident Fund account.
So all earnings benefit the fund members.
Correct. Nothing gets skimmed off.
It feels like there are rules covering almost everything. What about formal promises? Are there undertakings involved?
Yes. When an exemption is granted, the employer and all the trustees have to sign a written undertaking.
Undertaking to do what?
Basically, promising to follow all the exemption conditions we've been talking about. It's a formal, legally binding document.
Binding on them personally.
Yes, and on their successors. It also covers any new conditions that might be added later to keep the exemption going.
So it's a serious commitment. What if the exemption gets canceled later? Is there an undertaking for that scenario too?
There is. They also have to undertake in writing that if the exemption is ever canceled, they will transfer all the funds back to the RPFC promptly within the set time limit.
And if they delay that transfer?
They can face legal action. It ensures a swift handover if things go south.
Okay. How do we know the books are being kept properly? Audits.
Mandatory annual audits. The fund's accounts have to be audited every year by an independent chartered accountant.
Independent is key there.
Absolutely. And there's another layer. The CPFC, or the regional RPFC, can order a re-audit by a different auditor if they feel it's needed.
And who pays for that potential second audit?
The employer does. It adds an extra level of scrutiny paid for by the employer.
Double checks. Who sees the results of these audits?
The auditors have to send a copy of their report and the audited balance sheet directly to the RPFC.
Directly, not via the employer.
Correct. Direct submission within 6 months of the financial year end ensures the authorities get an unfiltered view. The format is specified by the EPFO too.
Right, clear line of sight for the regulators. Are there rules about who can be the auditor? Can they just use the same firm forever?
No, there's a rotation policy. The same auditor can't do it for more than 2 years in a row.
Oh, okay.
And they can't be appointed for more than 2 years total within any 6-year period. Helps keep things independent and brings fresh eyes.
Makes sense. Prevents getting too cozy. What about the company's own financial health? Does that affect the exemption?
Oh, significantly. If a company reports losses for 3 years straight,
Yes.
or if its capital base gets seriously eroded, the EPF exemption is automatically withdrawn.
Automatically. No ifs or buts.
Automatically.
Yeah.
Starts from the next financial year. It's designed to protect the employee's fund if the employer itself is financially shaky.
That seems like a really crucial protection for employees. What about inspections? Can the EPFO still check up on these places?
For sure. The employer has to provide full facilities for inspection whenever needed.
And pay for it.
And pay inspection charges, as set by the government. They have to pay these monthly. So yes, ongoing oversight, and they contribute to its cost.
What if, despite all this, an employer doesn't follow one of these conditions? What happens then?
Violating any condition can lead to the exemption being canceled.
Just canceled straight away.
Not usually. There's a process. They'd get a show cause notice first, basically asking them to explain why the exemption shouldn't be canceled. Gives them a chance to respond or fix things.
A chance to make their case.
Yeah.
Okay. You mentioned earlier the employer covers losses from theft or fraud. Does that extend to just bad decisions like poor investment choices?
Yes, it does. The employer is liable for losses due to fraud, defalcation, wrong investment decisions, or other mismanagement. The buck stops with the employer to make the trust whole.
That's broad liability. Now, companies change hands, merge, split up. What happens to the exemption then?
Any change in the legal status, merger, demerger, acquisition, sale, even forming a subsidiary, automatically kills the existing exemption.
It just ends.
Just ends. The company has to tell the RPFC immediately. And if they want to continue managing the fund under the new structure, they have to apply for a fresh exemption from scratch.
Right, so it doesn't just carry over. What if you have, say, several company units under one big common exempted trust? Who's liable if one unit messes up?
That's an important point. In a common trust covering multiple units, all the trustees are jointly and severally liable. Meaning, if one employer or trustee in one unit defaults, the RPFC can go after all the trustees of the entire common trust. Shared responsibility, shared risk.
Wow, okay. High stakes for trustees in those setups.
Yeah.
Lastly, can the government just add more rules later?
Yes. The central government always retains the power to impose further conditions if needed to continue the exemption. It allows the rules to evolve.
Okay, so pulling this all together, managing an exempted EPF fund is, well, it's clearly not a simple undertaking.
Not at all. It comes with a massive amount of responsibility, detailed rules, checks, balances.
Yeah, the whole system seems geared towards strong governance, careful money management, being transparent, and really protecting the employees' money.
That's the core purpose. Even with an in-house fund, these conditions exist to make sure employees get a deal that's at least as good and as secure as the standard EPF scheme.
Right. It's about ensuring this flexibility for employers doesn't come at the cost of employees' future financial security.
Exactly. The framework aims to provide that robust protection.
So thinking about everything we've unpacked, the board structure, the money rules, transparency, investments, audits, all of it. What parts do you think are really the most critical pillars ensuring that employees' money is safe in the long run in these exempted setups? It really makes you think about that balancing act, doesn't it, between employer freedom and employee protection?
It certainly does. Finding that right balance is key. Welcome to the deep dive. We know you're looking to understand complex topics quickly and thoroughly, and that's exactly what we aim to deliver today.
Yeah, hopefully we can make it clear.
Today we're tackling a pretty significant piece of work. The Employees Provident Fund Organization's annual report for 2022-23.
That's the EPFO report, right?
Think of this as your, let's say, streamlined audio version. We'll highlight the essential information you need to know about how the EPFO operated during that year. Basically, an audio walkthrough of the document itself.
That's a good way to put it. And this report, it covers a lot of ground. You've got performance, compliance.
Making sure everyone follows the rules.
Exactly. Then there's managing their, vast finances, looking after customers, HR stuff, legal matters.
It really is the whole picture.
It is a comprehensive look at a really important organization. So maybe we should start with how they actually measure their own success.
Yeah.
Performance management.
Okay, yeah, sounds like a good starting point. How does an organization this big even begin to define what good performance looks like?
Well, they set out their service commitments in something called a Citizens Charter.
The Citizens Charter, okay.
Now, the report mentions their overall vision and mission, but honestly, the specifics aren't really detailed enough for us to, properly dig into here.
Fair enough.
But what is interesting is how they've broken down the service standards for different groups of people.
Yeah.
The stakeholders.
Like who? Can you give us some examples?
Sure. So for someone who's, say, just joining, a new member.
Right.
The focus is getting them set up smoothly. Creating their UANN login, that's kind of their main ID for all things PF.
Universal account number, yeah.
Linking their KYC details, so Aadhaar, bank info, PNs.
All that.
Makes sense.
And making it easy to submit details for transferring old PF accounts automatically and nominating beneficiaries online.
Get the basics right from the start, basically. What about people who've been members for a while? Existing members?
For them, the EPFO points to resources like FAQs on the website. Useful stuff.
They also want members to know about potential benefits, so they have these online pension and EDLI calculators.
EDLI being the insurance scheme.
That's the one. Employees Deposit Linked Insurance. And importantly, they outline how a nominee should approach the EPFO if a member unfortunately passes away.
Right, practical guidance. And pensioners, what's key for them?
For pensioners, a big one is submitting their Jeevan Praman Patra, or, the life certificate, every year.
To prove they're still eligible for pension.
Exactly. Keeps the payments coming. The report lists loads of ways to do it: online, portal, banks, EPFO office, common service centers, even through the postman or mobile apps like UMay.
Making it accessible, sounds like.
Trying to, yeah. Now, on the flip side, you have the employers. Businesses dealing with EPFO, what are their responsibilities?
Good question. What does the report say?
Well, employers are expected to help their staff with things like KYC updates, UAN creation.
So facilitating the process.
Yeah. And promptly forwarding verified corrections if there are errors, replying to EPFO notices with the right documents on time.
Standard stuff, but important.
And they're encouraged to attend EPFO webinars to stay up to date.
Okay, now something caught my eye. The report talks about settlement times for claims. What are the targets there?
Yes. For pension applications, that's Form 10D, and for withdrawals or scheme certificates, Form 10C. The Citizens Charter sets a really ambitious goal: 7 working days.
7 days? That sounds quick.
It is, especially when you consider the actual legal limit under the Act is 20 days.
Wow, okay, so the 7 days is aspirational.
Very much so. It shows they're aiming to be much faster than legally required. They also aim for 3 days for issuing certificates for international workers and 7 working days for resolving grievances.
So these faster times are what they're striving for, but the law gives them a bit more breathing room. Good distinction. The report also mentions being prepared for disruptions.
Yes, disaster resilience. Basically saying they aim to maintain these service standards even if, something unexpected happens.
Makes sense. Okay, so that's performance. Shall we switch gears to compliance? How they make sure everyone follows the rules.
Let's do it. Compliance. For the EPFO, this really starts with making sure businesses, or establishments as they call them, are actually covered under the EPF and MP Act.
Which depends on what? The type of business, number of employees?
Things like that, yeah. Different sections of the Act apply. Once an establishment is covered, the employer has ongoing duties.
Such as?
Well, enrolling their employees as members, deducting the correct PF contribution from salaries,
Right.
and then depositing that, along with the employer's own share and some admin charges, into the fund. And filing regular returns, of course.
Standard payroll stuff, but critical. And what if a company doesn't do these things? What are the consequences?
The EPFO has several tools in its belt for non-compliance. They can levy interest for delays under Section 7Q and damages, like penalties, under Section 14B.
Okay, financial penalties.
And it can get more serious. They can initiate recovery proceedings, that's Sections 8B to 8G.
Which means
Things like prohibitory orders on bank accounts, attaching and selling company assets, and in really serious cases, even arrest and imprisonment of the responsible individuals.
that sounds pretty serious.
It is. The report also mentions prosecuting companies in court under Section 14 for various offenses,
Like what?
like non-payment, not filing returns, giving false statements, or being a repeat offender. And this is significant. They can file criminal cases under the Indian Penal Code, Sections 406409, for criminal breach of trust.
Breach of trust. How?
If an employer deducts the employee's share of PFO, but then doesn't remit it to the EPFO, that's seen as misappropriating the employee's money.
I see. The report mentions specific appendices with data on those cases. That really underlines how seriously they take it.
Absolutely. They could even use Section 110 of the Criminal Procedure Code to make habitual defaulters execute bonds promising good behavior.
Okay, quite a range of actions, but are they also making it easier to comply?
Definitely. E-governance is a big push. Online registration, auto-calculation of interest and damages,
Makes it simpler.
online payment options, the electronic challenge income return or ECR system, digital signatures, and even performance monitoring dashboards. Technology is key.
The report also talked about decriminalizing some offenses. What's the thinking there?
Yeah, there seems to be a move, guided by an ad hoc committee, to look at certain, maybe less severe offenses like delays in seeding KYC with the UAN and consider withdrawing prosecution cases.
So focusing more on facilitation than just punishment for everything.
Potentially, yeah. A more nuanced approach. Now, the Central Analysis and Intelligence Unit, CIIU, that sounds interesting. What's their role?
Like internal detectives.
Sort of. Think of them as the EPFO's data intelligence arm. They use data linkages with other agencies like CBSE, E6, the Ministry of Corporate Affairs,
Okay.
to proactively identify potential compliance issues. The goal is targeted monitoring and facilitating compliance, catching problems early.
Smart use of data.
Exactly. They've set up extensions in zonal offices for optional inspections, created a web facility for complaints about non-compliance with real-time tracking, and used dashboards to monitor pendency, using information smartly.
Okay. The report also mentions exempted establishments. What are those?
Right. These are typically larger companies that get permission under Section 17 of the Act to manage their own employees' PF contributions through their own trust.
So they don't pay into the main EPFO fund.
Correct. They run their own fund, but, and this is crucial, they still have to comply with the EPF Act's provisions. The EPFO acts as the regulator for these exempted trusts.
To ensure they're doing it right.
Exactly. Protecting worker interests, ensuring a level playing field. EPFO oversees granting the exemption, which involves the government and the Central Board of Trustees, or CBT, and can also cancel it if the trust doesn't comply. Trusts can also surrender their exemption.
So even managing their own funds, they're still under EPFO's watch.
Absolutely. The Board of Trustees for each exempted establishment has statutory duties maintaining accounts, filing returns, investing the funds according to rules.
Are there many of these?
The report says there were 3,344 PF exempted establishments as of March 2023, servicing over 13.7 million member accounts. So a significant number, concentrated mainly in states like Maharashtra, Karnataka, West Bengal.
Wow, that's a lot of members outside the main EPFO system.
It is. The report also briefly mentions provisions for recovering arrears from employers, both exempted and unexempted.
And finally, under compliance, there was a mention of the Atmanirbhar Bharat Rozgar Yojana, ABRY. What was that about?
Yes. That was a scheme launched during the pandemic to boost employment.
Right, I remember that.
EPFO provided the electronic facility for it. Employers could register, add new employees who met the criteria, and claim benefits through the regular ECR filing. The government paid a subsidy covering both employee and employer contributions for a period.
Directly into the employee's account.
Credited upfront to the employee's UAN's linked Aadhaar seeded account. Yes. Basically boosting take-home pay and incentivizing hiring. Another example of using their IT infrastructure for a Social Security initiative.
Okay, that covers compliance. Let's move on to the money side, the financial area. How is all this managed? The report details contribution rates.
Yes, it breaks down the percentages. For EPF, the employee typically contributes 12% of wages, and the employer matches that.
But the employer's share is split, right?
Correct. Out of the employer's 12%, 8.33% goes to the employee's pension scheme, EPS, and the remaining 3.67% goes to the EPF.
Okay.
Then there's the EDLI contribution, that's 0.5% paid by the employer, and administrative charges for EPF and EDLI, also paid by the employer.
And the government contributes too.
Yes, the central government contributes 1.16% of wages towards the EPS.
Got it. The report gives the actual figures for contributions received in 2022-23 from unexempted establishments. Huge numbers, I imagine.
Massive. Billions of rupees. It shows the trend over the last 5 years too, and the year-on-year variation really highlights the sheer scale.
And for the pension fund specifically?
It reiterates that it's financed mainly by that 8.33% employer share and the 1.16% central government share. And again, it shows the contribution trend for the pension fund over the last 5 years.
The report mentions something new about collection through Bank of Maharashtra.
Yeah, seems they started a centralized collection facility via internet banking for that specific bank from March 2023, probably aiming for more efficiency.
Makes sense. Now, the big question, what happens to all this money? How does the EPFO invest it?
Investments. This is governed by an investment pattern notified by the Ministry of Labor and Employment following Section 5 of the Act.
So there are strict rules.
Very much so. The report details the categories and percentage limits. A big chunk, minimum 45%, up to 65%, has to be in government securities and related investments. Think central and state government bonds, government guaranteed securities. Very safe stuff.
Okay, the core is safe. What about other types?
They can invest in other debt instruments. This includes things like bonds from public financial institutions, highly rated corporate bonds, like AAA rated, infrastructure debt funds, PSU bonds, certain debt mutual funds.
All with specific rating criteria, I assume.
Yes, strict criteria like minimum ratings for AAA for most corporate debt. The overall allocation to these other debt instruments has sub-limits.
And short-term investments.
Up to 5% can go into short-term debt instruments. Things like money market instruments, commercial paper, rated A1+, certificates of deposit, liquid mutual funds, and short-term bank deposits with qualifying banks.
Okay. Now, you mentioned equities earlier.
Yes, equities and related investments. They can invest up to 15% here.
In what exactly?
Shares of companies listed on BCNAs that meet certain net worth criteria. Exchange-traded funds, ETFs that replicate the Nifty 50 or Sensex indices, ETFs created for government disinvestment.
Interesting.
And even some hedging derivatives are permitted.
15% in equities seems significant for a pension fund.
It is, relatively speaking, compared to the past. It reflects a move towards potentially higher returns, but it's still a capped exposure. There's also a small category, up to 5%, for other investments.
Such as?
Units of infrastructure investment trusts, INVITs, and certain alternative investment funds, AIFs, category I and EI, again with specific conditions.
The report stresses the responsibility of the trustees.
Absolutely. Fiduciary responsibility, prudent investment, cost control, transparency, avoiding concentration risk, putting too much in one place. They also mention managing fees for fund managers carefully.
It sounds like a carefully balanced portfolio, trying to manage risk while seeking some growth. What about the pension fund specifically, invested differently?
Mostly the same. The report says the EPS fund is invested according to the same pattern, paragraph 52 of the EPF scheme, except for the central government's contributions and the initial corpus of the old family pension fund. Those remain in the public account of India.
Okay. And who actually manages these investments?
The debt portfolio for the main fund is managed by professional portfolio managers appointed by the Central Board of Trustees, CBT. They have to follow the notified investment pattern and any specific guidelines from the CPT.
How many managers?
As of March 31st, 2023, the report says they had appointed 2 portfolio managers.
The report mentions competition between them and dynamic benchmarks being beneficial. Why?
Well, having multiple managers competing can, in theory, drive better performance. And dynamic benchmarks mean their performance is measured against relevant, up-to-date market indices, giving a clearer picture than a fixed target.
How do they actually perform?
The report briefly notes their performance for the year 2022-23, but doesn't really give enough detail for us to analyze it here.
Okay. And finally, under finance, a mention of a productivity-linked bonus for EPFO staff.
Yes, paid out during 2022-23 for the previous financial year. Standard practice for many government-related bodies. Details are in an appendix.
Right. Let's move on to how the EPFO interacts with people, customer service, communications, and public relations. Sounds like a big focus area.
It definitely seems to be. The report highlights a strong emphasis on customer service and, crucially, grievance redressal.
How is that structured?
They have a dedicated customer service division at the head office and similar setups in the field formation, zonal, and regional offices. There are designated officers responsible.
And handling complaints, is there a central system?
Yes, they utilize the government-wide CP-TRAMS. That's the Centralized Public Grievance Redressal and Monitoring System. It's an online portal.
Accessible to anyone?
Yeah, through the main government PG portal. EPFO uses this extensively for receiving, monitoring, and ensuring redressal of grievances related to them.
Can you walk us through how a grievance is handled via CP-TRAMS?
Okay, so a grievance comes in online. It's typically forwarded to the relevant field office or specific division at the head office.
The one dealing with that member or issue?
Exactly. That field office is then responsible for redressing the grievance and uploading the reply onto the portal. The final disposal, closing the case, is often done by the Ministry of Labor and Employment or the Department of Pension and Pensioners' Welfare, depending on the issue.
So it's routed locally, but overseen centrally.
In essence, yes. Now, EPFO also revamped its own internal grievance system. It used to be EPI GMS, now it's EPFA GMS 2.0, launched back in August 2019.
And what are the improvements in 2.0?
Quite a few, actually. It's bilingual, uses OTP verification for security. Allows lodging grievances using the UAN, which is key. It integrates the UAN with their master database, so the grievance automatically goes to the right office handling that member's account.
That sounds much more efficient than generic routing.
Definitely aims for quicker resolution. It also has a very comprehensive categorization, like 60 different types of grievances.
Let's pinpoint the issue.
Right. And importantly, a grievance is only closed after the complainant confirms satisfaction. There's a feedback mechanism. You can upload multiple documents. It's interactive for comments.
So back and forth is possible.
Yes. Plus options for interim replies, dedicated email SMS alerts, a 3-level escalation path, regional office, zonal head office, and daily monitoring via dashboards. It's pretty comprehensive.
Who can use this EPF GMS system?
The report lists PF members, EPS pensioners, employers, and the category called Others.
And the numbers. How many grievances did they handle?
For 2022-23, through EPF GMS, they received over 1.42 million grievances and disposed of over 1.38 million. That's a disposal rate of about 97%.
Pretty high.
And they note that 78% were resolved within 15 days and 96% within 30 days. They also mentioned a reduction in grievances received compared to the previous year.
Suggests maybe things are improving or people are finding other ways.
Could be a bit of both. Besides the online systems, do they interact directly?
Yes, the report mentions initiatives like Nidi Apka Nikat, which means PF near you, and the Prayas initiative.
What are those? The report doesn't elaborate much, unfortunately, but they seem to involve direct interaction with stakeholders, possibly outreach programs or dedicated help desks.
Okay, and media communications.
They use the Press Information Bureau, PIB. Interestingly, the report notes no queries or grievances came via the ministry's media team for February and March 2023.
They're also big on social media, right?
Very active. Facebook, Twitter, WhatsApp, even Quora. They claim a 100% disposal rate for queries on Facebook and Twitter up to March 2023.
Impressive.
Plus, comprehensive FAQs on their website and 25 physical facilitation centers across the country are listed.
And internal changes. You mentioned a Chintan Shavir.
Yes, that translates roughly to a contemplation camp or brainstorming session. They discussed 5 themes: growing scope, Mission 10 crore, ease of compliance, developing staff, EPFO Karma Yogi, member satisfaction, seamless services, and focusing on pensioners, preparing for future. Strategic thinking.
Sounds like planning for the long term.
It does. They also celebrated their 70th Foundation Day in November 2022. Lots of events, an exhibition, a documentary, launching their Vision at 2047 document, releasing guides in 23 languages,
Busy year.
and virtual inaugurations of new office buildings in Ranchi, Pune, and Keonjhar. They're quite active on social media for education too. Facebook, Twitter, Koo, Instagram, YouTube, listing follower accounts and mentioning new accounts opened. They share info on various topics, even creating educative videos.
And finally, right to information.
Yes, they state their commitment to the RTI Act with designated public information officers and appellate authorities. The status of RTI applications is in an appendix. Seems like a multi-pronged approach to communication and service.
Okay, let's pivot to the people inside the organization, human resources. The report calls HR a vital division.
Understandably so, given the size and complexity. HR's mandate is described as nurturing and utilizing employee capabilities through policies on training, career development, performance management, seeing staff as an asset.
How many staff do they actually have?
As of March 31st, 2023, the total manpower was 14,872. That's against a sanctioned strength of 24,073. So, quite a gap there.
Significant vacancies then.
Seems so. The appendices break this down by level and location. The report also lists promotions made during the year across Group A, B, and C cadres.
Opportunities for advancement, at least.
Yeah. HR is also involved in organizational structure, studying and revamping it, creating posts, delegating authorities for efficiency.
Delegation seems key in such a large body.
It is. The CBT and the Central PF Commissioner delegate administrative and financial powers down the line. One specific example mentioned is delegating claim settlement powers to special state offices in the Northeast.
Why was that done?
The idea was to improve service delivery in those remote areas, ensure each state had a functional office, and bring services closer to members there. Approved by the Executive Committee.
Makes sense. They also looked at rationalizing big regional offices.
Yes, based on a norm. If an office had over 7.5 lakh contributing members, bifurcation was considered.
Splitting them up.
Essentially, yeah. To redistribute workload, maybe create new offices, ensure a more logical geographical spread.
Interesting. And they have awards for offices too.
Yes, the Havishanady Award 2022, presented on Foundation Day, recognizes best performing regional offices, large and small, and zonal offices. Came with prize money and trophies symbolizing security and support. A motivator.
Nice touch. What about recruitment?
The examination division handles limited departmental competitive exams and direct recruitment exams for Group B and C posts. The report details actions taken in 2022-23.
And being a government body, reservation policies apply.
Correct. The report confirms implementation of the reservation policy in recruitment and promotions. They also make compassionate appointments in specific circumstances.
And training. You mentioned HR oversees that.
Big focus on human resources development. Lots of training programs, webinars, workshops are conducted by their National Academy, PDNAS, and the Zonal Training Institutes, ZTIs. Appendix 8 shows the numbers participants, man days.
Any trends there?
Yes. The report notes an increase in the number of programs and participants compared to the previous 2 years. So ramping up training efforts.
Use of Hindi.
Active promotion. Participating in town-level language committees, honoring best offices for Hindi use, buying Hindi books, organizing Hindi fortnight events, hosting visits from the Parliamentary Committee on Official Language.
Standard for central government bodies. The report also briefly mentions things like internal reviews, asset declarations, disciplinary actions.
Yeah, touches on FR 56J reviews, AIPR, DR, mostly procedural mentions. More detail is given on staff welfare activities.
What do they offer?
There's an EPF Staff Welfare Fund with a budget of Rs 23 crore for 2022-23. It supports things like financial aid for medical treatment, death relief, education assistance, scholarships, marriage grants, help during natural calamity,
comprehensive.
canteen subsidies, health checkups, and a decision was made to open creches, childcare facilities, in 63 EPFO offices. That's quite significant.
That is a big step. What about sports?
They have a central sports promotion board and regional ones. Budget of Rs 5 crore for 2022-23. They organize zonal and all India level tournaments in football, cricket, basketball, volleyball, kabaddi, indoor games, athletics. Kabaddi was new that year.
Fostering team spirit, I suppose, and industrial relations.
Emphasis on maintaining a harmonious relationship with recognized staff associations through collective bargaining and open communication. Standard IR approach.
Vigilance. Keeping things clean.
Focus on preventive and participative vigilance alongside punitive action. mentioned inspections in 51 offices, number of complaints handled, and observing Vigilance Awareness Week with the theme Corruption-Free India for a Developed Nation.
Okay. And lastly, under HR, buildings.
Physical Infrastructure Division, headed by a chief engineer. They aim for all major offices to have their own buildings within 5 years and are enhancing current infrastructure. Mention the virtual inaugurations on Foundation Day again.
Right. So a lot happening on the HR front. What about training and research specifically? You mentioned the National Academy, PDNESS.
Yes. The report links training to the National Mission Karma Yogi program for civil services capacity building. Lists its 6 pillars.
And EPFO's training objectives.
Aligning skills with organizational needs, enhancing competencies, promoting a learning culture, preparing for future challenges, standard training goals,
How do they approach it, strategy-wise?
blended learning, online and offline, domain-specific programs, behavioral training, using technology, forming partnerships, a modern approach.
And the structure.
PDNESS in Delhi is the Apex Academy, supported by 4 zonal training institutes, ZTIs, in Kolkata, Chennai, Ujjain, and Faridabad, plus 1 sub-ZTI.
They have good infrastructure.
The report details facilities at PDNESS classrooms, hostels, library, IT lab, briefly mentions the training campus and admin structure, also lists facilities at the ZTIs.
What kind of training happened at PDNS?
Key activities are listed, number of programs, participants details again in Appendix 8I, also mentions monitoring and evaluation of training,
And research.
briefly mentioned. And the Chintan Shivir comes up again as a platform for brainstorming and strategy development.
Okay, now information technology. Absolutely critical, I'd imagine.
Couldn't function without it at this scale. The report lists some major IT initiatives from 2022-23.
Like what?
A big one is Computerization 2.001 project. Started January 2023, expected to take 16 months, aiming for a new centralized IT system.
A major overhaul then.
Seems like it. Also, an online compliance monitoring system for principal employers regarding their contract employees.
Useful.
The online pension and EDLI calculators we mentioned earlier were launched. Pan-India implementation of e-office to move towards paperless work.
That's a big undertaking.
It is. Commenced for 136 offices. Some started on Good Governance Day. Also, face authentication for digital life certificates for pensioners who struggle with biometrics.
Addressing practical issues.
Yes. A system-enabled end-to-end process for APRs, the annual performance appraisals, an in-house developed system called VCIT for tracking vigilance clearances.
Handling the data deluge.
Big focus there. Augmentation of storage, SAN and NAS, because of increased data from KYC, e-nominations, online claims, and capacity augmentation of their Oracle database with more licenses and servers to handle peak loads and improve application speed, investing heavily in IT backbone.
Necessary, I suppose. Let's talk audit. Internal audit first.
Right. The Internal Audit Division functions under the Financial Advisor and Chief Accounts Officer, FA and CAO, headed by an ACC audit. The report shows the structure and manpower at head office.
And notes deficits again.
Yes, deficits noted in various positions. Their role is monitoring internal audits across EPFO, ensuring rules are followed, reducing irregularities, scrutinizing audit findings, paras, and suggesting fixes.
What about audit in the field?
There's supposed to be 15 sanctioned internal audit parties, IAPs, at the field level, each headed by a deputy director audit, but
Staffing issues again.
major ones. Significant deficits reported in all IAP positions as of March 2023. Because of this shortage, only 6 IAPs were actually functional instead of the 15 sanctioned.
That must impact audit coverage.
You'd think so. The report lists the core areas these IAPs are supposed to audit in field offices across accounts, pension, compliance, and exemption. Specific verification tasks are mentioned.
Okay. Besides internal audit, there's statutory audit.
Yes, conducted as per the Act, and then there's concurrent audit.
What's that? Set up in 2017, you said?
Correct, with an audit portal launched in 2018. Concurrent audit is different. It's a systematic and timely examination of transactions, happening much closer to when the transaction actually occurs.
Not long after the fact, like traditional audit.
Exactly. The idea is to ensure accuracy, authenticity, and compliance almost in real time. Since 2019, some concurrent audit work on settlements was decentralized to the zonal level,
Objectives.
detecting procedural violations quickly, studying key transactions concurrently, and ensuring timely prevention or detection of financial irregularities or system weaknesses. Shortens the gap between transaction and examination.
What areas does it cover?
Key areas listed include checking for dubious date of birth name changes, multiple payments to the same bank account, payments from dormant accounts, high-value claims, certain pension revisions, PPOs, EDLI payments from exempted firms, claims using a specific appendix, claims from closed companies, member accounts with zero opening balance, and physical claims. No new areas added in 2022-23, though.
Does it generate many flags?
Oh, yes. The report gives month-wise figures for alerts sent by concurrent audit during 2022-23, totaling nearly 2.8 million alerts for the year.
2.8 million. What have they achieved with this?
The report shows achievements over the last 3 years. The number of alerts generated has increased significantly, the amount of irregular payments prevented has decreased, interestingly, and the amount recovered in response to alerts is noted, though the sums seem relatively small compared to the number of alerts.
What was the main issue flagged in 2022-23?
The analysis says the majority of irregularities observed were multiple payments going into the same bank account, so catching potential duplicate or fraudulent payments.
Okay, that covers the audit function. Now, legal matters. EPFO must deal with a lot of court cases.
Absolutely. The report classifies them broadly into two types: compliance actions, related to enforcing the EPF and MP Act, and service to subscribers issues, often under the Consumer Protection Act.
How did they fare in the Supreme Court?
The report summarizes performance for the year, cases decided in favor of EPFO, cases against, and cases remanded, sent back. It highlights some important pronouncements.
Such as?
Okay, one regarding the validity of a specific rule, para 26.6 of the EPF scheme. Another related to the 1.16% contribution from employees towards EPS, which was found contradictory but allowed to continue for 6 months.
That sounds complicated.
It often is. Also, upholding the principle from the R.C. Gupta case that there's no cutoff date for exercising the option for pension on higher wages.
A significant ruling for members.
Very. And conforming no distinction between employees of exempted and unexempted establishments for EPS benefits. Recognizing the government's power to amend the EPS prospectively or retrospectively, and the court issued specific directions under Article 142 for existing employees who hadn't opted for higher wages previously.
A lot of key pension-related judgments. What about high courts?
Statistics are provided. Over 2,600 cases decided during the year across various high courts. Breakdowns given for decisions in favor, against, and remanded. EPFO won the majority.
Any other significant legal events?
Yes. A draft scheme was prepared by NLSIU Bangalore regarding Social Security for gig, platform, and unorganized workers' recommendations forwarded to the Ministry of Labor. Task force formed.
Interesting development.
Also, recommendations regarding the functioning of regional committees suggesting 4 meetings a year, making coverage and litigation standing agenda items. The ministry notified an amendment accordingly, and legal task forces were set up at head office, zonal, and regional levels to monitor legal cases and submit monthly reports. More structured oversight.
Okay. Last major section. Social Security for international workers. Increasingly relevant, right?
Definitely. With globalization, more people work across borders. The report highlights the issues Indian professionals faced, like mandatory Social Security contributions abroad, potentially losing benefits due to minimum qualifying periods, and lack of portability.
So paying into two systems sometimes, or losing out altogether?
Exactly. So the Indian government decided to enter into bilateral Social Security agreements, or SSAs, with other countries.
What do these SSAs do?
They aim to protect migrant worker rights, coordinate the Social Security schemes of the two countries, provide exemption from double contributions, so you only pay in one country, usually based on where you're working temporarily.
That's called detachment.
Yes, detachment benefit, and crucially, enable benefit portability through totalization.
Totalization.
That means periods of contribution in both countries can be added together to meet the minimum qualifying period for benefits, like pensions. Provisions for international workers, IWs, were added to the EPF and EPS schemes back in 2008 and amended since.
Who negotiates these SSAs?
The Ministry of External Affairs, MEA, is the nodal ministry. EPFO supports the process, guided by the Ministry of Labor and Employment. EPFO is then the designated competent institution for operating these SSAs.
What does that involve?
Issuing certificates of coverage. COC, for instance. That's the proof an Indian employee sent abroad needs to get exemption from local Social Security contributions in the host country if an SSA exists.
Which countries does India have effective SSAs with?
The report lists them as of March 31st, 2023, along with the date they came into effect and whether they include detachment, totalization, and portability provisions. It includes countries like Belgium, Germany, Switzerland, France, South Korea, Netherlands, Canada, Japan, Brazil, and several others.
Quite a network building up.
Slowly but surely, yes. It's complex work negotiating these agreements.
Well, this has been an incredibly thorough deep dive into the EPFO annual report for 2022-23. We've really covered a huge amount of ground.
We certainly have. Performance, compliance, finances, customer service, HR, IT, audit, legal, international workers. It touches on almost every aspect of the organization.
And by going through this, hopefully our listeners now have a much clearer, more comprehensive understanding of what the EPFO does, what they achieved, the challenges they faced during that specific year.
It really does serve as a detailed audio guide to what's in that report, a shortcut to being well-informed about their activities and priorities for 2022-23.
It truly does. It leaves you thinking about the sheer scale of Social Security in India, managing funds and data for millions and millions of people.
The numbers are staggering.
And the ongoing challenges, right? Ensuring compliance from so many different employers, big and small, and how technology will continue to evolve to manage these incredibly complex systems. What does the future hold there?
Definitely some big questions to ponder. The role of data, automation, reaching the unorganized sector. It's constantly evolving.
Food for thought indeed. Thanks for joining us for this deep dive.